And we're going to talk about that from the banking perspective in about 10 minutes' time with an analyst from CFRA. I'm looking forward to that conversation. How hopeful is this, Francis, that unemployment goes to 4.5, stays there, inches up to 4.6 next year, 4.6 again the year after, which are essentially the Fed projections last time around?
Well, I said that much of what we're seeing right now is very traditional from the recession standpoint. Housing goes, manufacturing goes, and employment is later. But there may be two factors at play here that are different in this coming recessionary environment. And one of them is the potential that the unemployment rate rises less than it has historically. And that's because there is a psychology of labor shortage, labor hoarding. A lot of these people were very difficult to get into their seats and roles. So we may see the unemployment rise happen later or to a lesser extent than what we've seen historically. But at the same time, that complicates the Fed's job. They have a dual mandate. And if they're focused literally on the unemployment rate and inflation, we may see them again, I'm just going to say it over and over again, go later and avoid cutting.
On repeat. Francis, we appreciate it. Francis Donald, Matt Hornback, to the two of you, thank you. On this Fed decision day, coming up the morning calls and later, another volatile day for the regionals. We'll get the view from CFRA's Alexander Yoakum plus Troy Gajewski of FS Investments.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
About 5 minutes away from the opening bell. Equity's just about positive. Let's get you some morning calls. First up, Bernstein upgrading Marriott to outperform, seeing signs of resilient pricing power and strengthening travel trends. Bank of America downgrading AMD to neutral, expecting limited upside after the chipmaker delivered a tepid outlook. And finally, Susquehanna upgrading Uber to positive, highlighting the company's improving profitability and disciplined cost controls. Coming up, regional bank stocks remain under pressure. That conversation up next with CFRA's Alexander Yoakum and Troy Gajewski of FS Investments. Your opening bell up next.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe at just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Three seconds away from the opening bow this Wednesday morning. Good morning on this Fed decision day. Your equity market positive by 0.1% on the S&P, on the Nasdaq positive by 0.13%. Also struggling so far this week to put together a day of gains on the S&P 500. There's your opening bow. Switch on the board and get to the bond market. Yields shaping up as follows on a 10-year, down 3 basis points today. Monday up more than 10 basis points. Tuesday down more than 10 basis points. Monday it was prices paid on the ISM and a ton of bank issuance, or rather corporate issuance, coming from a ton of companies, pushing yields higher. On Tuesday, it was about banking stress, dragging yields back lower. In the FX market, a euro pretty much unchanged through most of this morning, now positive 0.4% at 110.40 on euro dollar. And keep an eye on crude. Crude with a break of 70 for the first time since March. Earlier on in the session, 69.30 were negative there by 3%. You'll notice at the Nasdaq, this is one to watch. The Committee to Protect Journalists ringing the opening bell at the Nasdaq on World Press Freedom Day, calling on the international community to demand the release of the hundreds of journalists unjustly imprisoned worldwide. That's a message we can all get behind. Let's get to the broader market. About 50 seconds into the session, we are positive by 0.1% on the S&P. One sector to watch at the open: regional banks. A volatile morning for these names after a rough day of double-digit losses just yesterday. Kelly Lyons has more. Hey, Kelly.
Yeah, John, it doesn't look like market confidence in these names has magically returned this morning. As you said, yesterday was incredibly painful. PacWest was down 28% in the Tuesday session. Western Alliance was down 15%. And this morning, a rebound very hard to find. PacWest at the moment down about 3%. And while Western Alliance is fractionally positive at the moment, it has been fluctuating between gains and losses all session. The regional banks as a whole, as measured by the regional banks ETF, up about 0.7%. But we'll have to see how it goes and whether or not it sticks. Because the thing is, John, there's not necessarily any new news for these regional banking names other than the news of Monday, which is that First Republic was taken over by regulators and then handed off to JP Morgan. But there remains an open question as to whether there are other shoes that have yet to drop. We still have massive questions around the idea of deposits fleeing to either too big to fail players or just higher yielding products. There's also questions around the regulatory and policy picture is going to look like. And there still is that issue of the asset liability mismatch and the pain of unrealized losses of higher interest rates, which are likely to get even higher when the Fed makes its decision today. Put it all together, John, and it still looks like confidence in the sector is very shaky, and that is perhaps exemplified best by the former Dallas Fed President Robert Kaplan, who told Bloomberg last night that this crisis is in its early stages, not the late ones.
We're going to stand those names for you through the opening bell over the next 10 minutes or so. In fact, through most of today. PacWest, Western Alliance absolutely slammed yesterday. Trying to recover this morning by 1.6% on the likes of PacWest. Western Alliance negative 1.8%. Katie, thank you. If you want to move, Estee Lauder right now sinking by more than 20% around the opening bell. Estee Lauder cutting the forecast going out from here, the outlook on a slow travel recovery in China, of all places. So that's a surprise. That stock is negative right now. That stock is down on my screen. Let's get it up for you. We are down by 19% there. Let's turn to earnings. Starbucks keeping its cautious full-year guidance. That outlook not sitting well with the street. Wells Fargo analyst saying it, quote, screams conservative. Abby has more. Hey, Abby.
Hey, John. And this is the worst day for Starbucks of the year, going back to October of last year. And what's amazing about it, they put up a blowout quarter, 2Q, second quarter comps coming in up 11%. The estimate had been up 7.3%. But it has everything to do with the outlook. Now, they didn't cut it, so this is interesting. They held it. But investors and analysts, as you were just mentioning, saying that this is conservative, that growth is likely to slow going forward. So relative to the numbers, they did put up 74 cents in adjusted earnings. That was 14% better. Revenues of $8.72 billion, beat by 3.5%. China upside, unlike Estee Lauder. But just reiterating that guidance, it's not enough, especially given the fact, John, that this stock is up more than 60% out of the October lows. For that kind of performance over the last 6 months or so, investors want more. They want guidance raised, which would suggest that the big beat we saw in the second quarter, that kind of growth is going to continue, that the company's confident in it. Instead, we have basically holding the growth. Let's see. But this stock, again, worst day of the year for Starbucks.
Abby, thank you. Here's another name. This was expected by a lot of people. AMD's ongoing PC slowdown weighing on its sales forecast. The CFO shifting attention to the second half, saying this: we remain confident in our growth in the second half of the year as the PC and server markets strengthen. Ed Ludlow in San Francisco has more. Morning, Ed.
Good morning, John. The 6% drop in AMD is the steepest since October. For the second quarter, they're forecasting sales of $5.3 billion plus or minus $300 million. I think the street was looking for the higher end of that at $5.5 billion. In the quarter gone, the data center business is flat. But as you said, we saw the PC slump we're expecting, a drop of 69% on the PC business. If there was a bright spot, gaming revenues held up in the quarter just gone. And looking forward, AMD is saying that margins will be around 50% in that second quarter, in line with what analysts were looking for. The narrative is around a recovery in the second half of this year, although it's interesting to look at AMD's forecast for PC shipments this year, which they say will be 260 million units globally. Last week, Intel has said 270 million units globally. So there's a small discrepancy between the two names. But yeah, this is definitely a market that's under pressure, and AMD is feeling it.
Ed, we'll talk about a market that's under pressure right now. It's the financials over the last few weeks. Ed, thank you. I want to turn back to the banks, obviously. Wolf Research downgrading shares of Comerica to peer perform, saying this: at a time when the regulatory environment is likely to become more stringent following several recent regional bank failures, we believe Comerica is likely to operate in capital accretion mode and should constrain Comerica's absolute upside potential over the coming quarters. And this is the problem. What's the profit outlook for some of these names? CFRA's Alexander Yoakum weighing in on the turmoil, saying this: the recent regional bank failures will have a negative impact on future earnings for the banking industry. We estimate the cost of replenishing the deposit insurance fund could translate to a 14% hit to the banking industry's earnings over just 1 year. Alex, I'm pleased to say, joins us right now. Alexander, great to have you with us on the show. I've been meaning to catch up with you for a while. You've made this really simple to understand in recent comments, and if you'll allow me, I want to share it with our audience. You said this: more deposit outflows lead to less lending, more expensive funding costs, and thus less profitability. And you went on to say the fact that the news is talking about banks so much is leading more people to realise their bank deposits are not paying much, which leads me to ask this question. Alex, this regional banking model, is this a viable business with interest rates of 5%?
Yeah, it's very difficult, especially the bank you mentioned, Comerica. That's a bank that has almost half of their deposits in non-interest bearing accounts. And like I said, with banks being talked about so much, People don't want 0% on their accounts right now. They're likely to move their deposits. The problem for banks is, their assets aren't necessarily repricing higher, so they can't pay, 3, 4, 5% on their deposits. So it is a very difficult position right now for banks. The good thing is they generally do still have excess deposits despite the outflows. But where the problem is when they have significant outflows, like Comerica, like PacWest, companies like that, that's where the problem really can, get exaggerated.
If they're going to struggle with rates of 5%, is there a solution outside of just cutting interest rates?
Yeah, there isn't necessarily a clear solution there. They can increase the rate they pay on deposits to try to, get as many as possible to stay. But there isn't necessarily a clear solution. And I think that's one of the reasons why banks are trading at such depressed multiples.
What did you think yesterday was? Some people called this some kind of speculative attack, that the shorts just moved from First Republic and piled into the likes of PacWest, piled into Western Alliance. Alexander, what did you think this was?
Yeah, I think there was a little bit of that. So First Republic, over 30% of their shares were shorted. Obviously a successful short. In general, pretty much all regional banks have not recovered very well. So there's been a lot of profitability for shorts. If you look at the worst performing names like Comerica, like PacWest, like Western Alliance, their short interest has tripled. And then, First Republic went down Monday morning. And basically right after that, you started to see the sell-off. So it's almost like the shorts switched to other regional banks. But yesterday, I really think there was just a fear for everything. People were looking at, which banks have high commercial real estate exposure, which banks have high levels of uninsured deposits, which banks are highly concentrated. The 3 banks that went down, including PacWest and then Western Alliance, all 5 of those, they all have over 50% of their deposits in a single state. So when there's fear, if all your clients are in the same place and they're talking to each other, that can kind of spiral and people might take their deposits out just because they get nervous.
Are you worried this gets worse before it gets better? Do you think more banks fall from here?
So it's definitely difficult to say. Unfortunately, it is a little bit of a self-fulfilling prophecy. So if people had actually listened to Jamie Dimon on Monday, I do think that there probably wouldn't have been any more failures. But if we do see significant sell-offs in bank stocks, I think it could result in more deposit outflows. Interestingly, most of these banks actually said that they saw deposit inflows in April, or at least their deposits were stable. But if the stock is falling 20% and you still have deposits in that bank, and you can get a higher interest rate somewhere else, there's not really any downside to take out your deposits. So it sort of makes sense, if you get nervous.
Alex, if it's not just about return of capital, it's also about return on capital. Does the FDIC coming out and scrapping the upper limit, does that change anything?
I could say it might, because, the 3 banks that went down, they all did have very high levels of uninsured deposits. The average in the banking industry is about 50%, and Silicon Valley Bank had 95% uninsured, Signature Bank 90%, and First Republic almost 70%. So if they did increase that number, I actually do think it could potentially help out.
Hey, Alex, appreciate it. Let's catch up soon. Alexander Yoakum there of CFRA on some of the regionals. What a mess it's been. Troy Hayesky of FS Investments telling investors to, quote, sell risk as we watch equities make new lows the next 3 to 9 months and the economy commence a recession starting sometime in Q3. Troy joins us right now for a conversation about this market. Troy, I assume you heard some of that. What do you make of it? What's the circuit breaker to end this mess?
Yeah, so look, the regional banks are in a tough position, particularly the mid-sized ones, because, of course, they're going to face more regulation. Obviously, if you have net interest margins that are not nearly as positive as they were, as recently as 6 months ago, and then you have had some of the outflows, particularly the Fed's reverse repo and money markets, it just makes for a very tough business case for earnings. Ultimately, when you look forward, this will more than likely be the Fed's last hike unless PCE comes hot again, and then they'll do one more. Behind the scenes, they continue to drain the balance sheet. And the trouble for broader markets continues to be the fact that valuations for the S&P are back up to 18.9 times this year's earnings, which is really only 10% below the multiple they were coming into 21 before the Fed hiked dramatically and went on the most aggressive balance sheet draining. So, from our perspective, you want to lean into strategies that have lower risk, mid to high single digit returns, Don't be a hero. Certainly don't chase this bear market rally. And then make sure in your asset allocation, you are prepared for material downside in equities over the next 6, 9, 12 months. If you're not, then you're going to, unfortunately, the math's pretty straightforward. If you lose 10, you need to make 11. If you lose 20, you need to make 25. And so what's so interesting to us, John, is, alternatives were a great use case for replacing fixed income really from 17 through this year. They still are, but it's almost more critical to embrace them to protect you from further downside risk in equities at this point of a cycle.
I want to pick up on the equity call just for a moment. One further question. Troy, when you look at what happened in March, banks failed, the equity market rallied. Going through April into May, First Republic went under, the equity market rallied. When you're looking for material downside at the index level, what are you talking about? Back to 3,800, back to the lows of October? What are you thinking?
Yeah, so from our perspective, we would assume that multiples have bottomed at 15.75 in October, which is slightly above 2002 bear market bottom and the 02 to 07 bull market. So let's assume multiples have bottomed. We retrace multiples now from, so it's called 18.8, 19 to 16 to 17. And then as we enter a mild recession, knock on wood, fortunately mild, instead of earnings growing by 10%, they contract by 10%. And that gets you right to that 32 to 3,400. So that's, let's call it somewhere between 15 and 25% downside from here, which would put the total peak to trough of this bear market, in the high 20s, low 30s. So not nearly as bad as 2002 or the global financial crisis, but significantly worse than 2011. So that's the framework we've always been using, or I should say over the last 6-9 months. And, remember, the thing that people forget is really up until the economy started to weaken, and now you're starting to see cracking in the labor market. Last year was all about tightening. We still have some tightening to go, and the next 12 months big risk to equities is recession, and instead of earnings growing, contracting. So the good news from an asset allocation standpoint is you have much less downside in fixed income. The bad news is you're in for another round of pain in broader equity markets.
Yep. Troy, you're going to be sticking with us. Troy Gajewski of FS Investments, just looking at the scores right now, about 14 minutes into the session, the S&P positive by 0.2%. The two names we've all been looking at over the last 24 hours, they're positive too. PacWest up more than 7%. Western Alliance up by close to 5%. Coming up, more data still to come ahead of that Fed decision.
What we're going to get today is a cautious hike from the Fed. They're going to open up some optionality, we think, for the next move to be a hike or a hold.
That conversation next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lang.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question its industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What we're going to get today is a cautious hike from the Fed. They're going to open up some optionality, we think, for the next move to be a hike or a hold. And that's what the market's going to hear today. It's going to hear a Fed that doesn't know if the next move is going to be a hike or a hold, but probably that the onus is on the data to now disprove the hold, because that's the base case.
Let's talk about the data. Mike McKee has more. Morning, Mike.
Yeah, morning, John. Couple of numbers just out now. The S&P Global Services PMI and the composite. Services a tick down, 53.6 from 53.7. And the same story for composite, 53.4 for 53.5. First of all, not much change. Those could be just statistical noise. And second of all, they don't really influence the Fed very much. However, at 10 o'clock, we do get the ISM Services Index, and that could be something that the Fed does care about today as they think about what happens next, because, of course, it's going to show us whether or not there's continuing growth in both employment and in prices in the services industry. We saw a big number in the ADP this morning of 225,000, roughly, for service industry job creation. And if we get that kind of indication from the ISM services number, might make the Fed a little nervous.
The prices paid component of the manufacturing ISM on Monday spooked this bond market, made people nervous, that's for sure. The rebound there. Mike, thank you. The ISM top of the hour. Alex Steele, Guy Johnson breaking that one down for you a little bit later, about 10, 11 minutes away. Just enough time to get into it with Troy Gajewski of FS Investments back with us for a final word. Troy, let's just start with the Fed and then we'll shift to some final trades. What are you looking for from Chairman Powell later?
Yeah, certainly a cautious hike, right, where they're going one more. They're going to be very data dependent from there, which is the right policy at this point, right? Because inflation's still simmering. It's metastasized to labor and services. They got to get that right. But at the same time, they don't want to hike to the point where we have a hard landing. So that's the expectation for the Fed, a very cautious hike.
5 and hold? For how long?
Yeah, so 5 to 5.25, right? Hold. We think at least 9 months, possibly 18. And that's really the biggest disconnect in pricing right now. Is
possibly
that,
18, Troy? Possibly a year and a half?
It's possible, right? We don't think it's likely, but if the labor market remains this resilient, even though it has been signs of cracking, and we somehow magically avoid recession despite a weakening labor market, then they could be on hold for that long. Because if you look at the trajectory of PCE, it's much easier to go from 6 to 4 than 4 to 3 and 3 to 2. Man, that's going to take a while.
Troy, what do you think this banking industry is going to look like if we have to hold rates of 5 for the next 18 months?
Well, look, the banking industry, other than the more fragile regionals, the system as a whole is in very good shape. I mean, we still have over $3 trillion of excess reserves. Even after accounting for the tremendous book value destruction from asset liability mismatching or duration mismatching, you still have more than 50% Tier 1 capital than we had going into the GFC, even after accounting for that. So the system is strong. Weakest links have broken. and there more than likely will be a few more to go. But we're not going to have the second, third, and fourth largest bank failures in history happening again the next 12 months. You'll have some smaller banks that go, but certainly nothing systemically important.
Well, we had the second biggest in March, and then it was taken over by the second biggest in April.
That's right.
First Republic. Troy, final word, investment ideas. What are you advocating for right now to clients?
Yeah, so look, depending on the strategy, you want to take advantage of some of this cutback in lending in the banking system. Private credit looks incredibly attractive, particularly senior secured commercial real estate. In more liquid strategies, focusing on interest-only strips that benefit from a decline in home prices. Our favorite way to play a gradual normalization in inflation, like we just discussed before, is through yield curve steepeners, where you're not taking directional risk. You're not speculating on Fed direction. You're just saying that as inflation comes down over time, it's natural that the curve, as it already has, will move from 100 basis points inverted to 75 basis points to 50 and ultimately steepen up. And so those are some of the ways to take advantage of what's going on in markets today and stay in that northwest quadrant, right? That's so important from an asset allocation standpoint to make sure that you're not exposing yourself to undue risk and can still grind out a mid to high single digit return. And the last thing I'd say, what's so fascinating about alternative strategies broadly now is the income component to returns is materially higher, particularly for those that park a large portion of the cash or net asset value in cash, and are also leaning into cash flow generative strategies, whether it's in IOs, structured credit, or long short credit and high yield. So still lots to do for the industry.
Hey, Troy, good to catch up. Thank you. Equity's doing better here, up 0.3%. The regional bank's doing better too. Your trading diary up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Let's call it 26 minutes into the session. Equities up positive by 0.4%. Let's get you the trading diary coming up at the top of the hour. We're going to get the ISM, 2 p.m. Eastern time. It's on to the Fed decision. Chairman Powell news conference. The ECB out with its own rate decision on Thursday, plus Apple earnings after the close. Fed speak back at the end of the week. Bullard Cook on Friday. Finally, payrolls as well to round out the week. The estimate so far, 180K. And coming up a little bit later, special coverage of the Federal Reserve decision. We'll be catching up with a whole group of fantastic guests, including the former Fed Vice Chair, Richard Clarida. From New York City, that does it for me. This is Bloomberg TV.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here we shoot for singles and doubles, and we definitely never want to strike out.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venagold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venagold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venagold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown. and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The US connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as describe about. Hey Ruchita, how are you? Hi Sindhu, fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have kabaddi, that the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle and the medium to long-term range. So ideally the electricity production is outside of the city and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like, I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising, so because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say shut up and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet! I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference that causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the years through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
And live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back and forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming in to our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1996, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
solar and wind energy were fully commercialized, there were a lot of amazing technologies implemented everywhere, I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100 kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100 kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
Shout at me. So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act from this side. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn. And he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian.
Hello, Mr. Hadi.
And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point we reported into him. You know, at the time everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because members of my team were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
There's no one else at the door.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed. Which, again, I just couldn't understand. What is the point of doing that? You know, this is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that if you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's
to
a
me.
very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, you know, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place, the granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed, the phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son Bobby wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it.
WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But You know, inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions, but Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil's going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m, that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as sort of desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
and it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks, and you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to 700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day, they all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, A lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. You know, any kind of social media presence they had has kind of closed down. By all accounts, they're, you know, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. You know, we just don't know. There's a number of potential outcomes for these guys. You know, potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be, you could be fined, you could be banned from trading, and, you know, in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. You know, one obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That, you know, they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that, you know, we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, you know, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. And this surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues. And they've been around for 7 decades. They've preserved about 125 million acres of land. And they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy, these companies have preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year! 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now once again imminently threatened. 72% of the trees are going to be cut within 5 years. Now this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon.
Right, legends, can you hear me? Tell me in the chat. We've got 1 hour, and I think actually the announcement will be in 30 minutes. If you guys can tell me if you can hear me, that'd be great. Got a little short opening, guys, earlier. Just put something on to get something like active on the charts. quickly, I do think here, you know, it's probably like that, and then maybe back down, retest the lows. We could see what's going to happen. If it holds above here on this level here, then I think we go higher. But that's just me. So tell me if you can hear everything, leggies. And then I think the announcement is, well, okay, 9 o'clock is the 9 p.m. Cyprus time, right? Is when we're going to get the meeting. But I think the actual rate will come out at basically 8:30 Cyprus time. If you guys can have a look, tell me in the chat, that'd be great. But we've got about an hour, leggies. Let me get back to you in a second as well. Tell me in the chat what the time it should be.
Look, our projects are just following the registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low cost offsets and a lot of them because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And
Leggies, here we literally go. I don't know if you can see me now. I'm trying to get all this hooked up, but I think you can see me. Looks pretty good. But yeah, I think we're looking at about 30 minutes time. I'm going to get the meeting. I've got the website here as well to watch the actual. So yeah, watch live May at 2:30 p.m. So that should be actually in 30 minutes. This should run. If I click play, let's see what happens. Fucking hell, that's loud. Maybe I'll just leave that in the background. So that's going to happen in 30 minutes, I think, or 2:30. That time it might be 9:30 here. Oh, it's just gone dead, I think. Let's have a look. Oh, right, that's just not even, it's not a live feed. That's not a live feed, leggies. So we'll leave on our other legends blasting off in the background. We'll leave that up for now. Anyway, it's going to be an interesting tradable day. We know that the FOMC meetings always do carve out some hilarious shit. Obviously, you know, we can't really know from beginning of this video. 1 second. We can't really know what's going to happen with this type of volatility. What usually happens is this. The usual thing that plays out is the Fed funds rate comes out and say the price goes up. As soon as he starts talking, 30 minutes later, it goes exactly the opposite direction. So there's no way to have any real understanding of what's going to happen to price. I would say probably Bitcoin pumps and then has a massive nuke afterwards. So just looking at this chart here, we got up on the screen. This is Bybit, by the way. But I say we get something like that, and then we probably fucking nuke after the meeting. That would just be kind of like my hunch. But, you know, we know that there's no point trying to look at news events to give you any edge in any type of trading strategy, because we know that news events are subjective in terms of whether you think they're positive or negative. So if you think that it's bad, you think everyone's selling, but actually that's subjective, because if you look at the market objectively, there is no evidence to say that someone else finds it negative as well. Someone else might find it positive. You know, that there's 20%, 25% basis points rate hike. Someone might think, oh, that's amazing, but someone else might think it's negative. So there's no quantifiable evidence to say that what you think is bad is what everybody thinks is bad. So then you can't use that in a strategy to actually get ahead, because it's not objective, it's subjective. And if you look at the market subjectively, eventually you're going to get proven wrong, because you're not everyone's always going to agree with you, motherfuckers. So ask me some questions. MDX, how the hell don't you already have billions of viewers on every video? Your content is absolutely the best of all friggin' time. I don't know, mate. Ask the community. Ask YouTube. Last bull market was amazing. We had a lot of viewers, but you know, you have your ups and your downs. And I always say this, you know, I used to make videos and just send them to my friend, or I used to make videos and send them to, you know, a family. And in that video, I would go and speak about the market in as much depth as I do in front of you guys. So, like, how I think of it is this, you know, even if one person watches my videos, like if literally one person watched my videos, that's the same as me talking to someone in the street or someone in a bar or someone at a restaurant. I'm just talking the same way I'm talking to you now. So if even one person watched my video, that just is in essence enough, because it means that at least someone heard what I'm talking about, or, you know, learning from the analysis. So I don't really ultimately do the videos just to try and pull numbers. Obviously, it's built into the human psychology. Let me just play that so we've got something on the screen looking nice. It's obviously built into human psychology that if you get 10 viewers and you get 20 viewers, then you get 100 viewers and you get 1,000 viewers and you get 10,000 viewers, and then you go back down to 200. Psychologically in your brain, you're like, oh, what happened? Am I doing something wrong? Is there a problem here? Oh my God, why have I gone down? That psychology there is pretty dangerous actually to most human beings, because you should roll it back and just be grateful from the beginning that, you know, you're still getting one view. And that is the human condition, just constantly looking for more and more and more. But if you roll it back and you really think about it, like if I go to a pub or a restaurant or a bar and I meet someone, he's like, oh yeah, you're the guy, you know crypto, you trade. I'm like, yeah, what's going on? I have a long conversation about price. You know, that's exactly the same type of conversation I'm having with you right now. So literally, the viewers isn't even what matters. Is trading, being profitable, building a company, MDX Algo as well, and having something which you can work for. And if you get one view, then one view is fine, you know? That's the same shit I do in the pub anyway. I'll be chatting shit like, hey, bro, what do you think about this? What do you think about that? I'm doing it all anyway. So one person's enough. But anyway, I appreciate your kind comments, sir. And also a bit more on the human condition. It's like people are always pushing for that next thing, okay? And I get it, because that's great for business. It's great for genuine humanity. Genuinely humanity is good, that we're always pushing for more and more and more and more. But there's always peaks and troughs with anything. Look at any market, look at anything in the world. High energy has to then have slow energy at some point. You know, it can't always be high velocity, high energy the whole time. You just blow out. So if you have a big phase where everything's going up, it's great. But you always have to understand that you're going to have a phase which is down. But then don't have that down phase and then automatically now think that you're having the down phase because you're now not good enough, you're now not better, you know, you're not getting the many views because you're bad. Don't think like that. Just think, I'm just going through a peak and a trough. If I just slowly am grateful and practice being grateful and say, I'm at this position because I did a big run up and now I'm in my trough stage, psychologically you're going to have a much better life, because a lot of people will just keep pushing until they blow out, and then they'll think, oh no, now I'm not getting what I did before. This is a problem. I've changed. I'm the issue. But actually, it's not the issue. It's just you're having a down trough. So anyway, that went on a bit of a rant, didn't it? I won first question and I'm blasting off for hours. Legends. Come on, meeting. I'm bored of waiting already. Can we hurry up, please? I want to watch meetings. Meeting now. This looks cool. What the fuck's going on here? Let me turn this on. Oh, yeah. Accelerate, baby. Hyperloop. Yeah, that's sick. Isn't that Elon Musk's thing? I've been watching this, actually. I've been in and out of all of today. I've left this stream on for about a few hours, but
automobiles,
this actually is a really good place to
Earth.
catch up with some interesting stuff.
But what if there was a fifth mode? And
Here he is.
I have a name for it, which is called the Hyperloop.
Yeah, Hyperloop me, baby.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes
train
into
a tunnel and then into a vacuum.
A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar
15 minutes
principle.
before the actual
pneumatic
announcement for the rate comes out.
was
I'm going to
short-lived,
keep
however,
the
only stretching
refreshing
one
this page
block
on my other
and
side.
topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself,
probably going to go to 5.
instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company.
Yeah, so fucking boring.
It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One,
now we're looking
it would
at
be
getting
renamed
into
to
5.
Virgin Hyperloop.
If 10x.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Yeah, so I think let's get rid of Hyperloop. Sorry, brother. So I think that what's going to happen, just let's go micro and then macro, but I think it's probably going to be 25 basis points up to 5. And I reckon they're going to stick around at 5 for at least 6 months. I think they're going to stick around at 5 or 6 months, maybe 3 to 6 months. And the markets are all generally going to go sideways. Up and down, but sideways ultimately for crypto markets, SPX, commodities, equities, you name it, traditional stocks and shares, right? I think it's all going to be generally like up and down, but flat, sideways. And then in about October, maybe a bit later in the year, November, I think we're actually going to get a big crash. I think we're going to get a big sell-off. All risk, equity, assets, all going to fall into cash, probably with the US dollar, but then we could look at some other foreign assets as well, foreign fiats. But then I think that's going to be a great buying opportunity towards the end of this year. But I do think everything's generally going to stay flat. It's going to rise a little bit. Maybe Bitcoin goes to 32, maybe down to 25, then 32, and is for a few months. And then I think at the end of the year, there's going to be a big dump, everything. I'm talking gold, equity, everything risk generally going to cash. Everyone's going to cash. And I think that's going to be a great buying opportunity at the end of the year. And I think then that crash will then carve out ultimately what the low is going to be for the macro low, and that will be the buying opportunity. Wait, Hyperloop, they're actually in one.
100 miles per hour is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
You can do it.
The number one question we got from investors or from project
proponents, I was looking at some stuff a few years back about Hyperloop, saying you could travel from London to Paris in 45 minutes.
Safe than by actually getting people on it.
How amazing would that be? Just jump on the train.
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving. And most importantly, they've probably gotten off of one before. They've seen someone get off of one before.
I think we do know how a plane works.
So what we set out to do was actually
very,
show
very
that Hyperloop
big
is safe
engines
with two normal people,
pushing
not astronauts.
The wing and the aircraft through the air at a certain speed, so you get lift on the wing. We know how aircrafts work, Legend.
Getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant...
Hyperloop will be way more secure as well, because obviously the whole thing's in a fucking tube for starters. And secondly, it's in no air. There's no friction or air. So where's the issue? And it's also going to be wrapped around the line, like you get those fucking fast trains
and before large governments are willing to come in and
trains
fund those costs,
in Japan.
Investors who are funding Hyperloop development must accept it as a long-term.
Guys, tell me what your predictions are for the Fed funds. We're going to get it in about 10
investors
minutes.
that are used to short returns because you're developing apps or something to that effect. You know, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century?
Yeah, it's a pretty interesting analogy.
And that's the part where you're going to get a lot more no's than yeses.
But Uber could exist without.
But there's people that have the ability, the fortitude to stick it out, to see the game-changing platform
or a device
here.
in your hand.
Those are the people that we're looking for. And
but it could work
since
with
we've done that
a
passenger
desktop
test,
instead of a phone,
there has been a lot of interest that's really, this is a lot sooner than I thought.
Imagine if we just skipped cellular completely, and we just went straight to. What if we skipped cellular and went straight to the internet? Just invented that earlier. Got to remember, like, the only reason we use like the infrastructure of the internet we have now is because we invented that one first. There could have been another system, another protocol that connects computers for information. It didn't have to be the internet. It could have been a different type of. It didn't have to be TCP using HTML. It could have been a different thing. It's the same as blockchain. It didn't have to be blockchain. The reason it's blockchain is because now most people are looking at blockchain, most money is invested in blockchain, and most human capital is aimed at blockchain. But it could have been something else like, what's that one, Hashgraph? It just could have been that, but it doesn't have the investment anymore, it doesn't have the human capital, so blockchain's just taken the winning spot. Everyone's invested enough into it now to just stick with that to make it work. We can always make every type of technology work, it just depends on the investment. When there is a will, there's a way, sir. Yeah, what's this about?
Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James.
Who the fuck are you, Alan?
And as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1000 kmh Hyperloop.
It's got some pretty sick shit, but he looks like he's been sucking wangers all his life.
It's fundamentally about
he made a rock. He made a fucking train look like a wanger as well.
To where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats typically.
That's pretty sweet.
Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds.
Yeah,
so to get from Liverpool via Manchester to
Leeds
by train is just short of 2 hours.
I love Manchester.
It'll probably take you
Leeds
2
is good
hours
as well.
driving as
Had a few
well
friends went to
in
uni there.
average traffic conditions.
And Liverpool as well. What am I talking about, legend?
Those three city regions remain three separate entities.
Can you guys hear this
Liverpool,
okay?
Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Wow. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers,
Brexit legends.
For business, for leisure, that is utterly transformational.
Yeah, that is unbelievable.
For high value
5
freight
minutes.
and logistics, it's equally transformational.
Yeah, that would completely change the tourist economy.
If you do
it won't be goods and
Hyperloop
services,
network
but
at scale,
tourism will just be absolutely
you begin
unbelievable.
to deliver massively significant carbon savings too.
Yeah, and carbon as well with
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra
just being able to flick on, you know, from
Hyperloops
London
will still need to
to
use
Paris in
electricity
10
to
minutes.
both move pods and maintain the
That's
near vacuum
unbelievable.
environment in the tube.
Just for tourism. and just
Proponents of the technology
interconnectability.
believe that this can be done by
It
using
almost
renewable
becomes like,
sources, including a combination of
the
solar
same
panels and
fucking city.
battery technology that could be used along the Hyperloop itself.
You could travel the whole way around Europe in an hour. You know, you could literally go from like
But even with
Liverpool,
all multipliers
Manchester
of
in
time
5
and
minutes,
carbon emission savings
Manchester
that a
to
Hyperloop
Paris
network may provide,
in 10
the
minutes,
investment
20 minutes.
capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
This guy's got a vested interest. He's done all the designs. He's like, government, please,
One
just say
company in the
yes, and we can
Netherlands is
work on the
working to
numbers
develop
later.
that technology, and perhaps more importantly, the international coalition
Guys, hit
needed
the
to
like
make
button as well
the
if you like this
Hyperloop
content.
network a reality.
We're going to get the meeting update in literally 6 minutes. So we've got the price chart up here. So I think like after we get the announcement of 25 basis points rate hike, I think we do get like something like this.
This is Tim
position
Howder,
is just
a co-founder and
small,
CEO
tiny
of
short
Hard
to be messing
Hyperloop,
around with just for the stream.
headquartered in the city of
It's
Delft.
literally in profit of like
And
30
while this
bucks or something,
testing tube might
$13,
not seem
like,
as
it's
large as
literally
others,
$2,000 short.
inside is a key
But I'm
technology
not
to create
really
the on and off
looking
ramp
at this
type
in terms of
infrastructure
a significant
Hyperloop
position,
network.
but I want to
That
see
is
if we do get
a
some
lane
sort of
switch.
spike up.
That's something
when we
we
get
can already test.
potentially, we don't know yet, but
here.
25 basis points rate
So
hike.
the track is diverging.
I think we could get a
from
spike
one
up and then
into two.
because that kind of confirms the pivot.
To eventually
And
split
then we're
up
getting
the
it. Look at that.
Hyperloop
We
track
haven't even got the meeting
in
yet.
two sections.
Maybe you have. Maybe you
And in that
have.
sense,
You
you
guys
can
tell
create
me
a
in the
complete
chat.
Hyperloop network.
Let me turn this
But
shit
in the
off.
end,
a
will make
second.
it possible to travel, for example, over a whole continent.
Because otherwise you can't hear me. I don't know if you can hear me, legends. Hyperloop, very interesting though. Very cool technology. But yeah, so we get some sort of moonshot up. And I think there's going to be a really interesting short position here. And I'm going to do this community in this chat. I'll let you guys determine the price of what we short. And I'll just click sell and we'll do a short together on this channel. Obviously, I won't go too crazy with you and do a $250,000 megalodon short. But we'll mess around. We'll mess around on this Shizmanism. And you can get this exchange, guys, with big bonuses and stuff like that. Also, you can get a free month with MDX Algo. So get a Bybit account with my link, and then you actually get a free month with MDX Algo as well. You just follow the steps when you get your first month. You can get 50% off and then claim the other 50% back in our system, MDX Algo. So we're coming up to this trend line now. Let's have a look at this Hyperloop thing again. It looks like interesting.
Very crucial element because this is the thing that limits the capacity and in the end the usefulness of the real network. Because the moment that a track is
I'm more interested in Hyperloop
that
right
means
now
that at
than
that
the Fed.
moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300
tell me guys in the chat
kilometers
what we
per
get on
We're now
the.
in
Do
a
you get
phase
the
where
Fed
we
funds
have
rate for me?
proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop
We're not there yet,
companies out
legends.
there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable
tell me what's gonna
traveling
happen in the chat
such
as well.
a system? So it's about all these different aspects, and the complexity
That's
is
immense.
really
That's mental.
getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
You're saying bring it to market like it's a freaking goddamn. Bring it to market like it's a fucking new T-shirt or a new mug you're selling. You're talking about Hyperloop system, which gets you from Leeds to Manchester in 5 minutes. Imagine the Shizm and Izza going from fucking Manchester to London in 10 minutes. And then being able to go from London to Paris and Paris to Spain and Madrid and down towards Lisbon. It'll be insane in like 5-10 minutes going around the whole. It could easily be done as well if you could really just get the government out of the way.
In order to help
some private company could easily do that. And Elon, basically. But not easily. But
Part in 2018 partnered with other Hyperloop companies.
More Hyperloop content.
The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for the...
Probably going to be some resistance around here, legends.
Standards drafting.
You know, if we get the
One of the most
rate
important
announcement
goals
and
for
it's
HART
25,
is interoperability,
we might get something like
which
this.
is essentially making sure
and
that
then
different
I am
systems
going to be looking
can
when the meeting
communicate
happens to come all the way back down and do something
Interoperability
like
is so
that.
important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the government.
Don't lie,
I
legends.
think in
You
that
can hear
sense,
me.
the biggest challenge that we've encountered is to really get
Q
all
on
the
us. I'm gonna
required
ban you,
parties
bro.
together
You can
to
hear
take
me.
the steps in
I know you can
development
hear me.
and
Can we all give
implementation.
Rob Q Os some hate in the chat, please?
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineering.
Right, can you hear me now, legends? Can you hear me now? Is it because it's too loud? It might be because when I play out, it's too loud. Maybe it has dropped. We can hear you, bro. So, guys, can you tell me in the chat? Can you hear me? And can you hear the Hyperloop shit? Can we hear the Hyperloop stuff? Oh, I can hear you now. Can you hear that? Can you hear the music from the... I hate sound. I hate freaking audio. Can you hear me, legends? All right, tell me in the chat, legends, what we doing on this whole fucking rate hike? It should be happening now. It should have already happened. Yes, too loud. All right, let's turn that shit down. Loud and clear, baby. Loud and clear. Woo! Want to get any louder? Oh, everyone's in the chat going mental. Yeah, so Legends, no more Hyperloop. Love the Hyperloop, man. It's such a sick project. They can really get that going. I want to be flipping around Europe, no passport, straight fucking through customs on a Hyperloop schism. Just tourism only, you know, moving it around. It's going to be amazing. Especially connecting something ridiculous like, imagine this in the future, London to New York under the ocean. 1 hour, New York, Legends. What's crack-a-lackin'? Thought I'd take a little trip on the other side. Right, guys, what's happening with the meeting? Are we getting in 28 minutes? Yeah, so we got another 30 minutes. So I think what happens is we get a pump from the announcement, and then I think we nuke back.
So as you look back on your career, what would you say is the best investment advice you've ever received?
What's the best investment
advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it.
It's just so boring. Like, come on, man. Like, we all know that, dude. Tell us something better. That's the number one thing. I would say it would be not to be a fucking emotional moon boy in anything. Don't get too emotionally attached to things. That's my biggest fucking word of advice. Think objectively and keep it objective fucking as much as possible. Because if you surround yourself with great people, they might be wrong because it might be subjective. You might be great, but you might be an emotional fuckwit. So keep it objective. That's the best way. Yeah, I know it has no real this video playing right now is like nothing to do with the Fed, but it has had moments where it has been to do with the Fed. So that's been interesting. But we got the Fed actual announcement video here. I don't know. Was it half past it starts? Let's check. No, it hasn't started yet. Hasn't started yet, Legends. Hasn't started yet. We'll leave that up there. Come on. Anyway, simple trade setup, guys. I got a stop loss in. I don't care if it gets stopped. There's only a small micro position just to have something on from earlier. But it's just a setup idea from the lower high. So you can see here, lower high. You can draw a 2-point, trend line from that, which obviously isn't going to be as significant as 3. But everyone's like, but you need 3 touch points. Well, if you're waiting for the 3rd fucking touch point, you're too late. So think, draw 2, and then maybe, guess what? It happened the 3rd time, but it was drawn from the 2, Legends. So everyone's like, no, but you need 3 to confirm it. Well, then you're too fucking late. It's like waiting for, but you need to have confirmation from the news. But BBC didn't agree. Yeah. There's that, isn't there? Anyway, so I'd say pop after the meeting. If it's 25 basis points hike, imagine if they went flat. That would be probably even better. So if they didn't even increase again, it'd probably be even better for the short-term spike up. But I think then it will get completely nuked. I think it's going to be up and then nuke. Everyone's going to get wrecked. And it's going to be a little bit of volatility. So I am going to have my finger on the button. I do want to get into some high leverage, degen position off the back of it. We've got the other charts here as well. Like looking at this, it's pretty much like yes, see on the flippers. But we'll see what happens, Leggies. Let's have a look what this twat's got to say.
Potentially another rate hike from the Federal Reserve, looking at an equity market that's positive by 4 about Lisa through today.
And do they have some sort of insight into that?
Oh, God.
Okay.
Into it. They know to the minute the deposits and the balance sheets of 20 or 30 banks out there.
And possibly some sort of preview of that senior loan officer opinion survey, which we're all really curious about. If they do, that's really what people are going to parse.
They're going to make that data more regular. I feel like we've been talking about that for months.
Did you just call that a barn burner?
Oh, yeah, I can't wait. It's like the minutes.
Tom's taking the day off.
Some.
TK's not going to be around May 8th.
I thought you said you were taking the day off.
A few loans. I mean, that's where we are.
Diane Swong joins us now.
Please.
One of our favourites, chief economist over at KPMG. Diane, wonderful to start the programme with you. Let's start with a statement. It comes out in about 24 minutes. Most people expecting a rate hike. 1, are you? And 2, how do you expect the statement to change in about 20 minutes?
Yeah, I think they do have to be nuanced, although, nuance is
20
the word of
minutes.
the day.
Can you hear me now
said,
talking?
First, I think
Put
they
a
have
yes
to
in the
leave
chat.
the door open a crack to additional rate hikes, even though
Hit the like
I
button
think
as well
they
if you can hear
intend
me.
to pause, and they hope this is the last rate hike of the cycle. The reason they're going to be leaving that door open just a crack is because we've got inflation that looks like, at best, it's moving sideways, and that's not enough for the Federal Reserve. I think we also could see a dissent at this meeting. Austin Goolsbee has sort of staked out his ground on this already. This will be the third official meeting
That's
that
what we're
he
getting,
votes
legends.
at. And I think one of the things he's very concerned about is that the tightening in the pipeline will do the heavy lifting for the Fed, and that they can't calibrate policy, and they don't want to go too far until they know more about that. And you're absolutely right, the discussion you had earlier, that they've already got a preview of not only what the deposit flows and leaving in and out are within the banks, but more importantly, that senior loan officer survey. They've been talking to everyone they know to find out how much credit market conditions are likely to tighten.
Diane, a number of months ago, we had the most fascinating National Association for Business Economics meetings in Washington. I thought the debate was as vigorous as I've ever seen. The debate at the Fed, are they relying on theory or are they making it up as they go?
They're making it up, legend.
Well, you know what? There's a little bit of everything in this. I think it's important to remember that there is no roadmap for where we're at. They are combating inflation.
studied monetary
It is not
history.
1994 where they preempted inflation and thought they could
Lovely.
fine-tune the economy. So I think that's a really bad threshold for a soft landing. But I also think it's important that even though we're combating inflation, it's not the same as the inflation of the 1970s and 1960s, although they want to avert the mistakes of the era. And that seems to be their focus. And I think that's what is important is the majority of the Fed. There's a growing minority
20 minutes,
that
legends.
are worried about how much they overshoot and that they can't calibrate a mild recession. And even mild recessions can be difficult to recover from. That said, this is a Fed that has put in their summer of economic projections enough of an increase in the unemployment rate to consider it a recession. And that's what they think is necessary to derail
Recession's
this
coming,
inflation.
guys.
I remember an entire month and a half ago, we
Look
were
at the
all really
markets.
worried about the Fed possibly signaling some sort of issue in the regional banking sector, and then that spurring some concern. No one's talking about that. Diane, is the Fed concerned about the messaging of raising concerns about the regional banks, given that they want to express some confidence in their strength?
They've been very consistent in terms of they want to stand behind how solid the whole overall banking system is, and their message has been very clear on that front. I don't think they're going to waver on that. That said, I think it is fair to assume that additional tightening in the pipeline will do much of the heavy lifting for them. And I have a little empathy for the position that Austin Goolsbee has laid out, where he sort of we'll see if he actually executes on it. But I don't think he's the only one in the room that would like to see the Fed wait a little bit and keep the door open to additional rate hikes, but see how much additional credit tightening there is in what could hit the backbone of the labor market, and that is businesses less than 250 employees. They accounted for a record-breaking 70.9% of total job openings in January, and have since lost some steam. The biggest loss in job openings as of end of March was in businesses with less than 10 employees. The important thing for the Fed is how rapidly does that credit tightening sort of act like a boa constrictor? Is it slow squeeze on the overall economy and slowly slow things down, or is it more abrupt? My guess is it's more like a boa constrictor at this point in time.
Diana, unfair question. How many more banks need to fail before that position is just untenable at the Federal Reserve?
I really can't even answer that. I can't even begin to, for a multitude of reasons. But I think what's important from the Federal Reserve's perspective, remember, we saw a lot of bank failures in the early 1980s as well. And I think from the Federal Reserve's perspective, what they need to see is how much credit tightening is really in the pipeline as a result of the financial market turbulence we've seen. That's very important. And what I'm concerned about is, although they're getting all the readings and they're going to get a preview to that May 8th senior loan officer survey, we still won't know what actually happens until it happens. This is a Fed that said it's data dependent. data dependent, data is backward looking. I think it's important
we look at the rectness
into
of this
account
shit.
How much they think is going to come in terms of rate hikes. And the question I would ask Chair Powell is how much do
This guy
they
said
think
long or short.
credit
This was
tightening
the area
in
to
the
get long.
system
'cause he had
already
these
in the
two
pipeline is likely to add
pointed
the
out here. So
equivalent
like,
to
that was the
in
long to
terms
get
of
into.
Fed fund rate
and all that.
hikes.
So I think,
You said sort of
you know,
0.5%
25
at the
basis
last
points is going to
meeting.
go up like
That's
this.
the question
If we get
to ask
flat,
them.
Diane's brutal.
it's going to be even
she's
more,
worse
and then
than
I think we get
Kate.
wrecked
Just
on
turn up
it.
the news conference.
She's just, I mean, I hope everybody's at the news conference. Leisman's over there. What did Diane say on Bloomberg? That's a brilliant question.
Of course.
You know.
As is everyone else. Diane, thank you. You're going to stick with us, I'm pleased to say. Diane Swank of KPMG. TK, the decision about 18 minutes away.
And you mentioned this today. I don't remember the context, but you parsed that the economy is small business as well. And Diane Swank was absolutely brilliant there on the smallness. Employees of 10, 20, 30, they're working off charge cards. They're working off maybe a loan that's three months behind. I think the tensions out there, to Goolsby's point, are a little bit greater than the macro babble you're hearing at Bloomberg.
Fantastic conversation coming up. Diane Swank, TD's Priya Misra, Deutsche Bank's Matt Lazzetti, with your Federal Reserve decision about 17 or 18 minutes away. The
17 or 18 minutes,
follows
legends.
that about 30 minutes afterwards. Your equity market, slightly positive. This is Bloomberg.
Yeah, they're going to whip it up. 25 basis points. I reckon we're going to pump up, and then when the actual meeting happens, half an hour afterwards, we've got that set up as well. It won't start yet, I don't think, but we've got it ready on this channel to have a look at what old Powell says. The ugliest man known to creation. The melting, ugly man. When he speaks, it's just his whole face is like flabbing, like... Whole face is not even constructed properly because it's just balancing on the hinge of fiat currency, not backed by anything. His face isn't backed by anything. Hasn't got any fundamental premise to it.
In big ideas, we show the that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Thanks, Kathy. Thanks for the update on AI. Go get wrecked. But I liked your BTC prediction. Let's buy some BTC and then say it's going to go to 1 million. Like every other fucking goddamn fund out there.
We have the Federal Reserve today, obviously.
Likely one and done.
One and done? One and done.
One and done is probably the answer here.
They're going one more. It's going to be a Fed that says, okay, look, we've delivered upon our dots. We remain data dependent.
They have said that they're very data dependent.
Seems like they're very focused on lagging indicators.
The Fed has its credibility at stake here.
And it gets really
like the Fed has any credibility left. What the fuck are you talking about?
More banking failures.
What are they credible for?
Putting more pressure on the banking sector.
They're now moving towards a pause.
But really, enemy number one here is still the inflation picture.
There is no way that the Federal Reserve is not looking at the set of problems that they have right now and getting very nervous about where they're going to have to put their chips.
Numbers
one and done. This is the countdown to the Fed decision on Bloomberg TV and radio. I'm Jonathan Ferro alongside Tom Keane and Lisa Brown. It's about 15 minutes away with the market shaping up as follows. The problem for this Federal Reserve is they say pause and this market hits cuts.
You know, balancing on the hinges of
positive 0.3%.
Not having anything backing
on the
his own
Nasdaq positive
face. That's why it's so
0.03 and a bounce back for the regional banks.
It's like a
and the
parabola.
small caps, the Russell, up by 1.5%. Into the bond market, 2-year, 10-year, 30-year. Take a look at the 2-year, 3.92. The last time the Federal Reserve met, March 22nd at the close on a 2-year, where were we? 3.93.
Oh, nothing's happened.
Nothing's happened between then and now. Looking at the 10-year, down 5 basis points, 3.37. And just to wrap things up in foreign exchange, Bramo, looking at the single currency, the euro, guess where?
Yeah.
Go on, guess.
110.
Right, I reckon we're going to get this.
Pretty much.
110,
Honestly,
110.
can I just
Let's
say,
have a look what we get
Diane
on the
Swonk
actual
was
rate,
saying, you know,
but I
will
think it's going to
Fed
be
policy act
one
like a
and
boa
above, or
constrictor?
what are they
And
fucking
I'm thinking
said?
about that as really being a perfect analogy. Is it a boa constrictor or is it a grizzly bear, right? Is it something that like slowly contracts the economy, or is it come in with claws and just tear it apart? I don't know. I think that's really good.
What is she talking
Slow.
about, Legend?
Maybe, and then all at once.
Yeah.
Perhaps.
You
No one
know,
knows.
this is
No one
important.
knows.
No, this
Yeah,
is
I know.
no, this
Nobody
is.
I know, but it's a good analogy.
Diane Swonk knows this, and so do Lizzetti and Miser as we bring them in. John, you're absolutely correct. It's slow, and ex post after the fact, and then they go with a vengeance because they're after the fact.
Two easy things to say today. Here's one. Okay, here's one. We're data dependent. I think that phrase is the greatest cop-out in Federal Reserve conversations I ever hear.
Yeah, go on, Jonathan.
It's
You
meaningless.
fucking tell him,
And I'll
Legend.
tell you for a few reasons. Dependent on what data? And how much weight do you put on each data point? When you talk about the totality of the data, the balance between what and what? Now, are you looking at financials, the financial system, financial stocks, stress, the data from last week, CPI, unemployment,
Hold on a second.
payrolls?
Public service announcement.
What
We
is
all
that?
have heard all of these phrases so many times
just,
that
you know.
I am completely with you, and I think it's
But
good.
he's
It's
going
well
to
taken.
say it in 40 whatever minutes time. He's going to say we are data dependent. Everyone's going to go, he's data
Yes,
dependent.
Lizzetti's going to go, are you kidding me?
He's data dependent.
Yeah.
It's meaningless. It doesn't mean anything. They've all got their different interpretations of the data anyway. If they were truly data dependent in some kind of mechanical, objective way, they would all have the same view on monetary policy, wouldn't they? Except they don't.
Herein lies the issue.
You're always data dependent by
It's the
definition.
level of cynicism.
Yes,
My children are
Jonathan.
data dependent.
You fucking tell them, Legend.
Let us continue with our guests. We've got Diane Swonk
Data
with us.
dependent. Yeah, I trade. I'm
keep us
data
on the rails.
dependent.
Diane
Most
Swonk
people
is here, and
aren't.
as we go to the meeting here in 13 minutes, Diane's begging, bring in Priya.
We got
Priya Miser
13
joins us,
no, we
TD
ain't got 10
Securities, and
minutes,
Matthew Lizzetti, Deutsche Bank. To have these three on with us pre-Fed is all I need to say about our great booking crew. Priya, let me start with you as well. Where's the 10-year yield, the metric that we're using here to guesstimate the inversion of 3 months 10s as Misra-like? Where's the 10-year yield 3 meetings from now, 4 meetings from now, 5 meetings from now?
Oh, who cares?
And I
Let's
think
just
it's
get to
because the
the
economy,
freaking
to the
shiz.
earlier discussion, the economy is responding to the lagged impact of rate hikes. I think that's more the boa constrictor. But then you've
The
also
boa
got the grizzly
constrictor?
bear, to use Lisa's analogy, because you've also got the
She's got a
banking
jawline,
sector
Legends.
that's in contraction. I think there has to be
This one's got a
massive bank
jawline.
deleveraging. We're in the midst of that. That's going to accelerate.
Yeah.
So you've
We've got
got
about
rate hikes.
10 minutes,
QT, I
Legends.
hope QT comes
10
up a
minutes.
little bit today because it's
Right,
tightening
desecrate the
policy and
chat.
it's not really talked
What do you think's going to happen?
so I
Flat
think tight policy is going to slow
25.5.
things down. So we think the 10-year is going to be much lower. 3-4 meetings from now, we'll be talking about rate cuts, and not just 100 basis points. I think a lot
Okay,
more.
just because of time period, I'm going to race to Matt Lizzetti. Or Matt, you've got the call of the year on a delayed recession. I guess we're finally to the
Yeah,
Lizzetti
desecrate.
slowdown, the Lizzetti recession as well. How restrictive are we right now? Diane Swonk mentioned a number of minutes ago that we may be a lot more restrictive than we feel. How super restrictive are we?
Yeah, I think one of the most important things that we heard from Chair Powell at the March meeting was all these financial conditions indices that ignore bank lending conditions should probably be ignored.
25.
That we really need to account for what's happening with bank lending conditions, the Fed Senior Loan Officer
thinking
Survey, credit conditions. There, I'm
Something like
hoping
this,
we're
like,
going to get a good
pops
read from Chair
out,
Powell
head
today.
of the
But
parapet
anecdotes that
comes
we
up
had
to
in the
around
beige
here,
book were that you
this
do
area,
have probably a
and then
meaningful
just gets
tightening that is taking
absolutely
place
nuked
there. On
back.
our broad financial conditions index, you are basically at the levels that you begin to see around recessions.
Something like
and
this.
so I do think broad FCIs, and when you incorporate bank lending conditions,
think's gonna happen
are at levels that are actually
with
pretty
this Fed
tight at the
meeting.
moment.
Diane Swonk brought up this issue of
But that's
whether
just my
the Fed
hunch,
would
Legends,
answer any
because
questions about
we
how
know
they
that
measure
these
the lag
days,
effects. And Matt, I'd love you to weigh
Fed
in.
meetings do
Are you
get
looking
very
for
volatile.
something similar? Do we have a
But
guide
there's no
to
real
understand
analysis you
how
can go
lagged
by
the
or a
effects
strategy
are
which
and
can
how
be like
quickly they're taking
definitive this
hold
is going to
now?
happen. It's a chaos day.
Yeah, I think the Fed has a bit of a tension here. I think for so long they were arguing that because of the forward guidance that they gave for how aggressive the tightening cycle was going to be, that they front-loaded a lot of the financial conditions tightening.
And we're going to do a YOLO
and therefore
trade
they
as
were
well.
not as behind the curve. Now I think they're in an environment where they want to emphasize that these lags are still to come and playing out over time.
Right.
I think what we've seen, certainly over the past day or weeks or so, is that these stresses in the banking sector.
Yeah, we're going to do a YOLO
are
trade as well,
likely
so I'm
still
going to
there. They're
desecrate
likely
this.
Still coming. They're
We'll
likely
slam
still
on one
tightening
Bitcoin
financial
just
conditions
for
as we look ahead.
banter.
And that is, I think, the reason
as the rate meeting goes, if we do get some volatility, I'm going to say in the chat, long or short, I'm going to fly over here, I'm going to market smash one Bitcoin, long or short.
About that idea, about the rate cuts and what the threshold
to do that
is it a banking stress issue? And
watching me get wrecked by your calls.
That's enough to get the Fed
Even though
to
I think, I'm fucking back in this community on this one.
The threshold to pause is actually not that high. The threshold to reverse.
She sounds like one of those ladies from Sri Lanka. I was in Sri Lanka recently, and they all have like the women especially who are like well spoken in English.
Kicking and screaming. I think the threshold is a few months of negative payrolls, and we're far from that. Does that happen by December? We think yes, but I would say if it doesn't, they don't cut rates, and they're going to be nervous about the economy slowing down. But I think
they really need to see. Some jump on some freaking gaming online.
Consequence
to batter a little bit of fucking Warzone.
So I think we need much sharper decline in the economy for the Fed to respond. This is not going to be a preemptive Fed into the easing cycle. I think it's going to be extremely reactive.
What an interesting point, Dan. I'd love your view on that as well. Do you think the bar is higher?
Come on, Johnny.
For cuts or higher?
You bald-headed legend.
Hiking again.
Johnny knows it. Hardcore.
I think the bar
He's got
is
structure,
cuts,
definitive structure to his face because he has backing. He backs up his points. Al, no backing on his face. His face is moving around. It's sluggish. It's goddamn falling off because it's not backed by anything.
Especially core inflation would continue to cool.
Remember, Powell's face is not backed by anything. Jonathan's face is backed by hard facts and good arguments. But Powell is slopping all, flushing all around the place. He's just done.
Think about what happens if inflation doesn't cool as rapidly. That means that real rates will not rise as rapidly as well. And that's why they may leave the door open a crack to additional rate hikes for the most hawkish on the Fed. The other side of this is what happens on the other side of what they call a mild recession. Hard to calibrate, first of all, once you get into a recession. Second of all,
we've got
many of the
7 minutes.
recessions we've had have been very difficult
25
to recover
basis points
from.
hike.
And there is a very long tail
and then I reckon Bitcoin's going to go up because it's going to be like,
oh
my God, they've gone flat. The pivot is done. One and no more.
Even in the most occupied office
one
markets
and done,
in the country,
sir.
Like Houston and Dallas, where you have 60%
it's going to be 25.
Moment,
that's going to be inherently the confirmation that the pivot has begun. So it's up, and now it's stuck. It's going to be like 5
in the pipeline they've ever had.
5.
Matt, do you agree with that?
And then
that there's actually
I reckon 6 months of 5.
To cut rates than to raise.
It's going to be a great 6 months.
The market seems to have. The market thinks that it's a given that the Fed's going to aggressively cut rates through the end of this year and into next.
I don't think so. 6 months.
I think no doubt it's actually a higher bar to cut rates. I think to get there, you need to see the unemployment rate rise materially. I think you need to see what are likely recessionary dynamics playing out. I do think that the bar to hike rates at some point later.
Also, just to say as well, guys, my prediction is this, and I'll say it again, there's more people here now. So I reckon they go flat generally for the next 6 months. Right, it's going to be about 5% for 6 months. Everything in the market's risk is going to go frothy and be volatile flat. It's not going to be up or down swing. It's going to be flat, sideways range. Bitcoin's probably going to be fucking around from 25 to 32, bouncing, ping-ponging. Equity's going to be the same, maybe retest a little bit higher. Commodities exactly the right same as well. And it's going to be flat for 6 months, maybe 3 to 6 months, just to be completely clear. 3 to 6 months of 5% interest rates. When they begin to bring them down, they bring down interest rates. I think there's going to be a big crash. I think all risk is going to go down, even commodities. Everything's going to cash, depending on what cash you want. Usually US dollars, but could be something else, looking at the US dollar situation. And then frickin' there's going to be a big dump at the end of the year between October and November, maybe December, because I don't like to bet against December. But anyway, between October and frickin' November-ish, I reckon it's going to be a big collapse. That's going to be the buying opportunity into risk, where you're going to be buying stuff like Bitcoin, gold, stuff like that, maybe some stocks and shares, individual Russells, whatever. That's going to be the play. Because I don't think actually we're going to get what people think when the rates begin to come down. I think it's going to be the opposite, and then there's going to be a good opportunity. But I think it's 5% and flat for 3 to 6 months. I don't think they're going to bring them down that quick.
If the Fed is not cutting rates, I think the 10-year will start to sell off, because that means that soft landing scenario is more likely. Right. We're very much in the hard landing. Everything seems to be pointing towards a slowdown. It's just timing that slowdown. And can the Fed get ahead of it? We think not.
Priya, will we see market reaction today? The last couple times it's moved one way and then it's moved another way 3 hours later. Same silliness, or do we get something profound today?
I think Chair Powell's going to try and buy time. I mean, if he hikes 25, that's almost priced in. I don't think he's going to commit a whole lot to beyond that. So you would think that's not a big market reaction. But there's a lot of nuggets in the press conference. Does he brush aside the bank issue, calling it just a few bank mismanagement? That's a hawkish message. Does he actually say that inflation's much higher than the Fed thought? That's a hawkish message. Or does he talk about credit conditions? We think that senior loan officer survey, we don't have it. We think the Fed has it. Are they more concerned about it? That would be a dovish sign.
3 minutes.
And the market's skittish. I mean, we're moving 20 basis points on a daily basis.
So
while I don't expect a big market
I'm thinking we're going to get announcement, something like up again and then crash.
A surprise, I think, would move the market. And then we have payrolls to look forward to and CPI.
Come to resistance here, like I said before. I said up to this. See it as resistance.
Do you think he'll come anywhere near
I had a position short here, but that was just to show,
whatsoever for what's happening in the banking
sector. I took that off a second ago, and now I'm waiting basically for you guys to do a YOLO trade with. I've got my positions open. I'm going to slam down buy or sell and ask the community, buy long, sell short, market smash one Bitcoin. We're going to buy or sell one Bitcoin on this channel today.
But not rate hikes are supposed to
get ready, legends, and see what
happens.
That's
what they did. Why some banks were more impacted by others? I think that the Fed is going to push back. I don't think the Fed takes responsibility on that front, but certainly on the supervision front.
It's certainly not clean. It's a dirty way of doing it. But Matt Lazzetti, is this a feature, not a bug, of monetary policy?
Yes, Johnny.
Look, I think it's a feature of monetary policy. The Fed is looking to tighten bank lending conditions. They're looking to tighten financial conditions. I think the big surprise recently has been that they haven't tightened as much as anticipated. Credit spreads have been so tight. So this is, I think,
these
a
blue
feature.
zones you see are marked out by
in the
MDX
right direction.
algo.
Obviously, they don't want
check out MDX algo, legends, and just come in.
And they will deal with that to the extent that they can through other tools. But tighter financial conditions, tighter credit conditions is a necessary condition for them to be able to achieve their dual mandate objective.
Diane, I wanted to give you the final word going into the news conference, not just the decision about 2 minutes away. 30 minutes after that, Chairman Powell delivering that news conference. You gave us a bit of a tease earlier in the conversation, what you'd asked Chairman Powell. Can you elaborate on that, Diane?
2 minutes. Hit the like button if you're interested
Chairman today
in seeing what's going to happen.
Well, I'd like to know
Desecration
how much they
is
think
key.
there is tightening in the pipeline, and to emphasize something that Priya made the
1
point
minute
of
now.
is it's a
Let's do this
bimodal distribution, and that's why the Fed isn't concerned about the fact that some expecting rate hikes and some not. That
25
is, some
basis,
are expecting a hard landing
25.
and some are not. And the Fed is less concerned about that. But I
Long
think
the crap
most
out of it.
important issue we want to know right now is
I'm
how
looking for
much
it to come
do
up
they
and then
see
probably
credit
short, but
tightening
we'll look at what we're going to do. I'll ask the community in a second.
I think it's easy for the Fed to say we're divorcing combating inflation and rapid rate hikes.
It's not a great spot for it to be right now,
but breaking up
for price
is hard
action
to
for
do.
it to be
And
when
in
we get
fact,
the actual announcement,
the Fed
some
has
sort of
always
move.
used rate cuts as a form
We'll
of
see.
stabilizing financial markets.
There is no
That's not an
strategy
option
built
when
around
we're
these
combating
events. It's just
inflation.
we know there's volatility,
Diane,
so it
thanks
can be
for being
fun
with
to
us
play those
alongside Priya
trades.
Misra, Matt Lazzetti, Dan Swank there. We are about 60 seconds away from a Federal Reserve decision. Live on TV and radio, special coverage will continue. 30 minutes after that, we'll have a news conference with Chairman Jay Powell. TK, what are you looking for in the next minute?
What I'm looking for in the next minute is definitions of pause. There's 18 ways they can say pause. I hate this phrase, hawkish pause. We're going to have a hawkish pause.
Got no idea what we're going to get.
A dovish action. It's just a
Here we
primal
go.
screen
Like I said,
to not do what your mandate is and to go somewhere
has it come out
with
already?
a slower U.S.
25 high,
economy.
yeah.
And
So I reckon
the
it's
bet's
pop,
out
and
of
then
this.
let's get ready.
You
Let's
take
get ready.
Ed
Let's get
Hyman,
ready.
He's looking for second half recession, much like Matt Lazzetti, and you look at Neil Dutta going completely the other way.
Bramo?
Come on, let's go.
For control find regional banks. That's
Like
it.
I said, guys,
I'm
there's a
gonna look
pop-up,
for
and then we're going to get
control
nuked.
find lending standards, control find credit tightening. I want to understand what they know about this.
Decision, 15 seconds away. Here's the price action going into it. Positive 0.3%
Yeah,
on the
it
S&P
that might have already
500.
been
Your
it,
bond
and then we're
market
gonna
shaping
nuke.
up as follows. 2-year, 10-year, 30-year. The 2-year, 392.84 on a 10-year yield, 337.49. With the decision, here's Mike McKee.
Here's Mike
hawkish
McKee.
pause. Fed officials, as expected, raised their target rate by 25 basis points to 5 to 5.25%. But they go on to suggest that the longest and the steepest tightening cycle since the 1980s may be about over. The statement drops wording anticipating
Yeah, well, the
some
volatility
additional
actually
policy
usually
firming,
comes
now saying the committee
when
will
he starts
closely
talking.
monitor incoming information
Got
and
that in
assess
30
the
minutes.
implications for monetary policy. In determining the extent to which additional additional policy firming may be appropriate. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The vote was unanimous. The economic summary notes a modest pace of growth in the first quarter.
Yeah, it wasn't in the right spot. It did get that little bit popped to the upside, but didn't really get anything on that.
And still elevated inflation.
I'd say if you just zoom out a few ticks, you're probably looking that was a short anyway.
Because there's no change in their estimate of the financial stability situation. They go on to repeat the U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. And finally, no change in the pace of QT, still capped at $95 billion a month. A short, sweet statement, but it does suggest that we are going into a possible pause.
Mike McKee, thank you, sir. Thank you, Mike. Let's whip through the price action for you. In the equity market, a lift on the S&P 500 up by almost 0.5% on the S&P. A move lower in yields at the front end by 5 basis points. Call it 6. We're down to about 390 on a 2-year. Let's just get to the FX market just briefly. Guess where it is, Bramo? Euro dollar.
I guess that the dollar is 110.
110. Yes. 110.74 on the euro against
the
the US dollar.
So, you know, it's popped up like we did on Bitcoin, but nothing really too exciting.
Off the back of some of this,
like I said at the beginning of this video, I thought we were going to get a
so
pop-up.
just to summarise what Mike McKee just went through. Third paragraph in a statement.
And now I think
one
we're
line
going
in the last meeting we were all talking about for so long. The committee anticipates that some additional policy firming may be appropriate. Replaced with this, so I'll read through the quote again for you. The committee will closely monitor incoming information and assess the implications for monetary policy in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. DK, just a little bit to get through there.
A little bit to get through.
If it comes back up to here,
change, a little bit of excitement,
like this area,
gets us to.
Oh, look, to get into a short.
I want to count the number of questions in the press conference where he doesn't have a prepared statement.
And then stop loss above the highs.
Count than the ones with a prepared statement. They're all going to be there, and they're going to be carefully.
Yeah, this is live now.
The least. Someone that's written those statements.
This is going to start in 30 minutes.
Economics at Bank of America, and joining us at our headquarters, Torsten Slok.
So, Powell's in the building, is he, sir?
Torsten, let me begin
the flabby Powell, the man who has a face that is not backed by anything.
Which of your little vignettes
his face has no intrinsic value. That's why it's so flabby and wrinkly.
Which is the latest that matters to
Come on! Why are you doing this to me?
This statement is the weight of
Why is it doing
highly
that, Legends?
uncertain effects of the banking crisis. And on the other hand, they are very explicitly saying the committee remains highly attentive to inflation risks. So it's still this incredible laser focus on inflation. And I do think that inflation in round numbers at 5% is still way too high relative to their 2% target. So they're still looking in the rearview mirror and saying, we just don't know quite yet how bad this banking crisis is going to be. And we just don't know, therefore, how much credit conditions are going to tighten.
Yeah, they're just going to keep bringing them up until 5 and then
but you'd probably walk off the set with a hook for Mr. Moynihan, so we won't go there. Michael Gapin, I want to talk to you about Fed policy, and I want to get right to it off this press conference. What will we learn about the June meeting?
I think that the main thing on the June meeting is we can't rule out further policy rate hikes. We don't think we will need to raise rates. We think we're done, as Torsten said. We want to evaluate how the ongoing stresses from the
so if we come back up to here, I'll look for short, but you know,
activity.
It is what it is.
The message will be we don't know entirely that we're done. It's possible that the spillover effects will be limited. The labor market will remain relatively solid, and we may have to do one or two more. We can't fully rule out action in June at this point.
Where are we going to be?
We'll see,
June 14th. Bramo, let's talk about it.
Could be an interesting long as well.
So this is what they said back on March 22nd. They were talking about the financial stress. The banking system is sound, resilient. The extent of these effects is uncertain.
That was a long
The committee
before,
remains highly attentive to inflation risk. Let's go to the new statement. Second paragraph. Same stuff. Banking system is sound and resilient. The extent of these effects remains uncertain. Well, that's one extra bank that's failed since the last time they said that.
About 25 minutes till the actual meeting. Tell in the chat, guys. I think most of you guys got it right.
And
25.
how many other banks will be talking about at the same time?
And that everyone will agree. Do you find it interesting that there was no dissent, given the fact that we've heard so much dissent in all the talk that we've gotten from some of these Fed members at a time where there is a great deal of uncertainty, but pretty polarized views and strong ones at that?
I find it very amazing, Torsten Slok, that there is no dissent today, do you?
Well, I do think that their focus on inflation is really just continuing. I mean, they have said for a long time, we got to get inflation down to 2%. And the honest look at the data is that inflation is just not moving down to 2%. And now you on top of that have the housing market showing more signs of recovery. And that has a weight of 40% in the CPI. And if home prices and owners' equivalent rent starts to go up again, you could really have inflation sticky at very high levels. So I think they're keeping the optionality, the flexibility here at the moment.
Thorsten, you've said credit crunch is coming. You said credit crunch was here. Isn't that going to take care of it for them?
Yeah, so the problem is that the credit crunch is somewhat remote from the recovery in the housing market because the labor market is still strong. So there's all these domino bricks that need to fall in place before we need to see the labor market soften. And Jay Powell has clearly said we need to see the unemployment rate go up. And we're just not quite seeing that yet. We'll see on Friday where we get. But you're absolutely right. There's a number of things that need to happen first. And it's all monthly data before we can come to the conclusion that things are truly slowing down. And therefore, inflation is coming down to that target.
Michael, can you weigh in on this? Basically, is the implication here that in the Fed's data, perhaps that we don't even see, the stresses in the banking system really are not that great, or it's really just been perhaps overblown by individuals like myself, and that actually the inflationary outlook is still the preeminent concern, even with the ability to possibly not raise rates.
So it could be a sell here.
I think that's a fair characterization in the sense that
higher
the
low and then flip up.
It is still the preeminent
I actually do think
risk.
maybe this will run to here before we get the dump.
Stresses. They certainly
I said for the 4, I think it's like that, and then
with the lag. They don't show up right away. Our work suggests it could be 2 to 3 quarters. Certainly a shorter lag relative to policy rate hikes, but it's not instantaneous. So I think they're in this balancing act where the macro data is still pretty good on balance. They think they're going to get some excess tightening out of banking system stress. Until they know where that lands, inflation is still the #1 concern. I think that's what the statement's trying to balance at this point.
Torsten, to Diane Swank's question, how do we measure the lag effects?
Well, one data point we get next week, which is the Fed Senior Loan Survey, is at least one very important observation in getting how bad was it actually here in the latest data. And we already get some information about the second quarter telling us what are banks' willingness to lend. Did they tighten lending conditions to large firms, to small firms? Overall, that will be a very important, at least, step on the way to figuring out how severe this is.
If you want to use this exchange, guys, the links are below. 2 exchanges, Bybit and OKX, best exchange in crypto.
The 16th bank in the US.
If you use Bybit as well, you can get a free month with MDX algo.
2 balance sheets of more than 200 billion. This is not just a small corner of the financial system. This is going to have a fairly significant impact. And as Michael was saying, the risks are that now financial conditions in the regional banks, of course, will tighten. And with the regional banks or the small banks making up 40% of all lending and 30% of assets in the banking sector, this is something that you should be quite worried about the downside risk for the macro.
You know, every bank has a different fabric, Michael Gape, and I think Brian Moynihan loves the micro data of banking. With the reach you have at your institution, what's the temperature that you take of the banking into the real estate system? How does that work into your weekly note or what you're going to write off of this Fed meeting?
I think if I could also just pivot a little bit off of what Torsten said there in terms of next week and the
no pun intended,
Senior Loan Officer survey. Does it stay focused on commercial real estate and C&I lending, or does it migrate into the consumer and, to your point, the residential real estate market? Because right now there is a bit of a split. It's tightening towards firms and commercial real estate, but not so much towards the consumer and residential mortgages. The consumer is on better footing. The housing market domestically is frozen in its tracks a bit, but the banking sector is still willing to lend into that sector on net. So I think that will be key to kind of gauge the downside effects or the outlook from my perspective.
Second half of the program, so now time for your useless slogan number 2 of the program. It was data dependent previously. It is not 2008, which is the one that people love to say at the moment, Torsten. It is not 2008 because it makes you sound really intelligent, sophisticated. You lived it, and you know that this is not 2008. It means nothing. Every crisis is different. Of course it's not 2008. It's ridiculous to even have the conversation. It means nothing. We're always benchmarking to the extreme. Always. We do it with tech stocks. It's not 99, 2000. Except bad things still happen. It's not 2008. I find that slogan, that phrase, useless. Let's park it. You said it's important. It is still not good. Banks are failing. 1, 2, 3, 4. Throwing Credit Suisse, make it 5. How big is this problem?
Yeah, so you're absolutely right. If you look at the CRE as a share of the economy compared to residential real estate as a share of the economy, it is small. In particular, CRE office is even smaller. But there's some indicators that are worse than in 2008. If you look at the University of Michigan question about what are your interests in buying a durable good, conditions good or bad, and the share of the population that's saying that things are bad because credit conditions are tight is now double at the level it was in 2008. So both for consumer credit conditions have been tightening, and the New York Fed also has a question where they ask households, have you been declined access to credit? That's at the highest level in a decade. So you also have, going back over the last 10, 15 years, that we have a situation, in particular when it comes to credit conditions, that things are not moving in the right direction. You could say, well, this is because the Fed is raising rates, but adding a banking crisis to the Fed raising rates is just creating this risk of a nonlinear slowdown.
So, Mike, for a long time, the Federal Reserve has talked about acting ex post after the fact. Should they shift to ex ante, given essentially what's playing out before our eyes in the banking system?
Not until they get more clear evidence that inflation's coming down, and therein lies their conundrum, right? It's their primary focus. They have to get inflation down to 2. They've got uncertainty to deal with, so they can't be too preemptive unless they're going to, they risk missing then on their inflation
If you come down here and get a higher low,
yes, at some point they may have to be preemptive, but I don't think we're going to get that message now.
Yeah, because by definition, data dependency is looking in the rearview mirror. So if you refuse to look out through the front mirror and not look at everything that's going on in front of you, you will, of course, focus on, as Michael is saying, on the past data and not so much on quantifying the very difficult issue we have in front of us.
I keep thinking about the boa constrictor and the grizzly bear. We were talking earlier with Diane Swank about the boa constrictor just kind of tightening around the economy. Mike, how quickly can the economy just absolutely fall into a downward spin? Or are we so far away from that type of recession, that type of downturn, that just doesn't seem probable?
Yeah, I'm sorry. I don't think that that's a base case, but I mean, to answer your question, right? It's the sudden stop theory of recessions is all about, it's when credit flow stops. That's your problem. So that could happen very quickly, meaning in a matter of a couple of months, you could certainly see that. We're not looking for that. Certainly, we think we're going to get some excess tightening out of the regional bank stress that will help slow the economy down. But I don't think a hard landing from us is a base case at the moment. The sudden stop theory would tell you, if there is a major credit shock coming, if it happens, forcefully and fairly uniformly across not just small banks but medium and large, then you're going to see those effects pretty quickly. We don't think we're in that world yet.
And I agree with that. I mean, the bottom line here is that there are many other sources of financing than the regional banks. Of course, private capital, there are market securitization, securitized credit cards, auto loans, and those other sources of financing have been able to pick up some of the slack. And thankfully, credit spreads are still at reasonable levels. So that means that the regional banks can be replaced to some degree by other sources, including private credit.
Can I give you both the final word on this? I've asked this question a few times today. I think we all have over the last couple of weeks. Do you believe that monetary policy objectives are in conflict right now with financial stability?
So at least from my chair, I mean, the way I think about that is that you cannot say that it's completely separate what's going on in the banking sector relative to hitting the inflation goal. Of course, hitting the inflation goal is about cooling the economy down. It's about cooling inflation down. And in that process, cooling the financial system, cooling credit conditions also involves an impact on banks, and in particular, in this case, also on regional banks.
Mike Gapin, your take?
I would agree with that. The two are not entirely separate. Obviously, when you tighten monetary policy, it will increase the cost of the credit, slow the growth rate of credit. That could put some institutions under stress. They're not entirely separate. I would associate with Torsten's remarks there.
Hey, Mike, great to catch up with you.
It's
Mike
really
said
wonderful.
in the last week or so, enough juice for one more hike, and we got one more hike. I love that line, Mike. You know that. Torsten Slok for Apollo. Torsten, great to catch up with you, buddy, as always. TK?
Right now, as we go to Bill Dudley later in the program, the former president of the New York Fed, we are advantaged by the former vice chair of the Federal Reserve System, Richard Clarett of Columbia, and of course, global economic advisor at PIMCO. Dr. Clarett, I just want to cut to the chase. You wrote an economist essay about the IMF meeting that I hope everybody
15 minutes legends before the actual meeting.
Which is, it's really going to be hard to get back to a 2% level. Where are we heading across the meetings of 2023 with the inflation dynamic you describe in your Economist article? And with what
legends.
we
Let's
see
get 200
from
likes
the
in
Fed, where are we going to be in June and on to the December meeting?
Well, thank you for having me on the show, Tom. I guess a couple of points. I do think in the statement today, as I think others expected, they did adjust the language, and so they definitely want to have the option not to hike at the June meeting by including that language on the extent. But I do think this is a committee that will, and we'll see this from the chair today, I imagine pretty soon, is going to emphasize they're not declaring mission accomplished. Inflation is way too high. And certainly this will be, I think, sold, and they believe that it's a pause, and they're going to do what it takes. Now, looking ahead, I have written and do believe that, under a plausible scenario that the Fed has laid out in the projections, which I broadly agree with, inflation a year from now could be running in the 2s, but probably not near 2.0, probably north of 2.5, maybe closer to 3. And I think at that point, the committee will have to make a judgment, but if it sees progress on inflation, then it's shown in the SEP projections, they think they can be adjusting rates downward. But I don't think they have to get all the way to 2 before you see those adjustments.
Come on, legends,
if
15 minutes.
Where we are with
and then we're ready to bounce on our
calculations that people like you make up to see what the path is forward, there are other ways within the system to be more restrictive. And of course, one of them is banking trauma. Are we more super restrictive now or more tight than the chairman realizes?
Well, I'm not sure what the chairman realizes, but I do think, and I certainly believe that what we've seen with SVB, First Republic, Credit Suisse, the cumulative effect of that, even if there are no more disruptions, will be to tighten bank lending. I think that's equivalent to some additional rate hikes. So whatever rate hikes you might have thought the economy needed, say, in late February, probably fewer now, because this is going to slow the economy. Person who I really respect talked about the other markets for supply and credit, but a lot of small firms and businesses don't have access to those markets. So when bank lending slows, it'll impact a small business hiring and employment, I think, pretty substantially.
Given that credit interruption, do you agree with Diane Swank and Matt Luzetti earlier, who said that they think that the bar is higher to cut rates than to raise rates again after a pause?
Well, let me think through that. I think that inflation's just too damn high. It's not
inflation's just
something.
Too
it's
damn
in the
high.
Whatever progress appeared to be evident in the data in the winter has now, at best, stalled. And so, yes, I think this is a committee that is going to be very reluctant to ease until it really does start to see inflation moving down sustainably. And so I would agree with that.
So right now, as we look at this statement and we understand what you're saying, what more do they have to see in the banking sector?
Right, 10 minutes, legends, before the meeting.
To say, okay,
get to listen to old pal
this is something really
on with his
serious
flabby
that needs
face.
a little bit more scrutiny.
His uncongealed together face, because it has not backed by any fucking secure
we've resolved two
integrity behind it. His
banks,
face has no integrity
in the sense that they collapsed and they had to be acquired, facilitated by the FDIC. Look, let me say what I do believe. The banking system as a whole in the U.S. has enough capital, has enough liquidity, and is profitable. So this is not an issue about the banking system per se, but clearly there are fragilities among certain banks, in particular in that category between 100 to 250 billion, and we may not have seen the last of that.
If you are just tuning in live on TV and radio, this is a special edition of Bloomberg Surveillance covering the Federal Reserve decision from about 20 minutes ago. They hiked interest rates 25 basis points. If you're interested in the language shift in the statement that we got from last time they said the committee anticipates that some additional policy firming may be appropriate. A couple of lines have changed around that. The line now reads, in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over the time, the committee will take into account the cumulative tightening of monetary policy. Off the back of this, equity market positive on the S&P by 0.4%. That's on the S&P 500. In the bond market, yields a bit lower at the front end. Not a big move. That move phased just a little bit. We're down about 3-4 basis points on a 2-year, 3.92. Just to look at foreign exchange briefly, the euro stronger, dollar weaker off the back of all of this, 110.65. The news conference, you're laughing, aren't you? 110 euro dollar. You love that.
Yeah, it's great.
11 minutes away from that news conference. It doesn't seem to change, Rich. I keep saying the same thing. Rich, I just want to jump in on the banking stress. Your former colleague, John Williams of the New York Fed, has really played down the role the Fed has played in this by hiking interest rates from 0 to 5 so quickly in a little more than a year. I'm just wondering what your assessment of that is, the contribution of Fed policy over the last 12 months to what we've seen play out at the regional banking level.
Good question. I have enormous regard and worked closely with John for nearly 4 years. I think as a Fed official, he is careful in how he chooses his word. I'll just tell you what I think. I think in every rate hike cycle, banks that have exposure to interest-sensitive assets are going to face challenges. You know, in the case of First Republic, they held a lot of mortgages. Mortgages
they go on crazy leverage and take risks.
In the case of SVB, they held a lot of
when they mess up
because
they took a risk. There's always a fucking risk to a reward. You can't just have the reward and then you take a risk and you get bailed out.
And when bond yields go up a lot, some banks are going to be challenged. And so I just think it's an inevitable part of monetary policy. As I said, the banking system as a whole is sound, but banks that have big exposure to rising rates that they didn't hedge are not surprisingly going to get hurt.
And I can ask you this because you're the monetary guy. If you're the regulation guy, I couldn't ask you this, Dr. Clarida, but you know, for you it works, and with your experience and your public service to the country, it's real simple. Everybody's scared stiff. LIBOR's back to where it is. This new SOFR's back to where it is. Kathy Jones over at Schwab is just out with where the FDTR rate is. It's back to where it was, which is 2006. Michael Spence was eloquent in 2010 about the regulatory failures leading into 07, 08, 09. Are we there again?
Tom, I don't think we're there. I don't believe we're there. What I will say is that, and I think the report that we got out of the Fed and the GAO, I certainly read both of them carefully, and clearly there were things that were missed, not so much in regulation, but perhaps in supervision. And I do think that we will see that changed pretty quickly, and certainly I think that would be a good idea.
Rich, you know the Federal Reserve in your time there has been heavily criticised over the last few months regarding this issue. Can you share some of your experience in your time? Did these issues ever come up at board meetings that you attended around the names that have failed over the last 2 months?
I don't know. You know, here, legends,
any way, shape,
I'm going to say
at the board
it's a
level
short
in
into
DC?
resistance.
Well, let me just.
But I do think when we get the meeting, I think it could be a pop-up into here, and then I think it's going to be a snapback.
I was surprised by both of these based upon my entire experience, and in particular, what I would say is,
I keep having problems with the bit rate.
There was a focus. It was in statute in 2018 that the Fed should tailor to the individual banks regulation and supervision.
Is the quality really bad?
Is important, but I think these reports do indicate that
I've got good internet here as well, but I keep blasting the bit rate up. But
I guess another way to ask this, Rich, is just whether this goes all the way up to Jerome Powell in terms of his oversight of individual regional bank regulatory exercises. In other words, is he somebody who would have known some of the granularities here, just to give us a window into what that process is?
Yeah, I think I'll just leave my answer at that. Obviously, I've not been in the building for 15 months, and I'll just leave my answer at that.
All right. Well, just to give you a
It's usually pretty good. If I do this, it'll probably go down.
Well, Rich, you know, the reason why this is important is because people often think of these as independent items, right? You've got on one hand policy, and you definitely have an inflation problem. But John, you have to wonder if at a certain point you're kind of challenged.
5 minutes before FOMC,
and
then we got the flabby man.
You were there
with no foundations to his face.
SVB's gone under. Signature Bank, First Republic, Silvergate. When you were hiking interest rates this aggressively at the Federal Reserve, was this on your radar? And Rich, if it was on your radar, why was nothing done about it in a sufficient way to prevent this from ultimately materializing?
Because they didn't know.
Well, I was there in 2018 when we hiked rates up to 2.5% and paused at that level. I continue to say, as I did earlier, when I got a similar question, the banking system as a whole is sound. It has a lot of capital and liquidity. And so at a top-down macroeconomic level, it certainly was not then a concern.
Rich, what's so important here is John's question. And I know there was a pandemic and all of the estimation of the glide path of the great medical miracle of getting out of the pandemic. But a lot of cynics would be saying that well-meaning people have been basically practicing modern monetary theory with the Biden
I just need to get a better laptop, don't I, legends?
It was is. And now we're trying to extricate ourselves from it. How do we extricate ourselves from the Fed, the deficit, the debt ceiling, the other worries that our listeners and viewers have? What does he do in the press conference to help us
got dual monitor up as well, so I've got another monitor here up.
Well,
I need to get a beastier
I think
laptop.
there are a lot of moving parts there.
If it's to do with if he's saying that's to do the bit rate, then maybe I need to just
doing his job, keeping at it till the job is done, but being attuned and attentive and sensitive to what we're seeing in the financial system. And I don't expect him to move beyond that. But Tom, you are right. The thrust of your question, these are all related, and obviously they all impinge on monetary policy.
This is the heart of the matter from the head of economics at Columbia University for so many years and what he did with Gertler. John, this is a Fed that has to get back to a laser focus on what the original mission was. Through the pandemic, there were all these other issues. The social policy that was, it's gone off in the crisis that we're in.
Let's be clear. That was driven by the chairman himself.
Yes, I agree. I totally agree. But the point is to what the former vice chairman is saying, they're going to get back to a more focused process. That would be one guess.
Well, let's focus on the next 4 minutes. In about 4 minutes' time, we will have a news conference with Chairman Powell. Rich, let's wrap it up there. What would be your focus going into this news conference, just as a spectator now from outside the Federal Reserve, looking at this play out?
Well, thank you for that question. I do think that the statement today will be helpful in that, because I do think the goal coming into the meeting, notwithstanding what we saw with First Republic, was to give themselves the option to pause. But certainly, I think the chair will stress that they're not. It's not mission accomplished, and they've got a lot of work to do. So I think we'll hear a fair amount of references to that, because I think he and the committee do want to guard against the pause being heard as done or pause being heard as rate cuts. How's the bit rate looking, guys?
That sounded like a thanks for not asking me about the banks again, Ramo, I think. Richard Clarida, thank you.
Thank you so much.
The former Fed Vice Chair, wonderful to get your perspective on this monetary policy decision. Going into the news conference in about 3 minutes' time. 25 basis point hike delivered, widely expected. One and done, the phrase you've heard so many times coming into this. Are we truly done, Lisa? And for how long? Because you are never truly done, are you? There's always something next.
We're data dependent. I just want to tweak you.
Okay.
But listen, this is the issue right now, is what data, and that is really my question. Is it going to be the senior loan officer opinion survey? Do they already have that? And if so, what guidance can they give us? Oh, and if it's not that, how much are you looking at specific components within the inflationary reads? These are some of the issues,
by my,
as well as, of course,
Fed prediction, FOMC, something like this. And then
isn't it? I think it is. I've said all along this press conference is going to be interesting in how he frames it out to the coming meetings here. What's so interesting is Professor Clarida alluded to is the wide set of issues here that are really outside the capabilities of this institution, and yet he's got to allude to them. Will he comment on them?
Well, there's another one, isn't it? We haven't talked about it in the last 60 minutes, the debt ceiling. Nobody wants to talk about it because what can you say? But ultimately, you'd have to think you get to the June decision, Elisa, and you could be at a very interesting point down in Washington, D.C.
How much is the debt ceiling debate tightening financial conditions in the very short end and making the job even more difficult around regional banking, because you're seeing those 3-month T-bill yields at the highest levels now, going back to 2001? Is this because of monetary policy? I don't think so. I think this is a debt ceiling disruption kind of issue.
Also, if you get the kind of spending cuts that the Republicans would like to see, Tom, you've got to factor that into your projections at some point as well.
That's clearly outside the scope of this press conference. But what I would go back to is their estimate of the real economy, and do we get any whisper of the knowledge they have? And McKee is very big on this. They have knowledge about the banking system on a day-to-day basis. It's like almost like military intelligence, far greater than anything we have. Does that give him a confidence here if he knows good things?
Aliens must look at human beings.
And what will he choose to share? I think Lisa's been on top of this all along. May 8th, right?
Yeah.
May 8th, the senior loan officer opinion survey we're all waiting for.
You'd
imagine, Lisa, he's got a decent idea of what that's going to look like when it comes down next week.
Animal instinctual world.
Can he give? Can he
we live by rules dictated by animals. all other animals feel the same emotions we do. We're just we're just a combination of all the animals you see and the apex of those animals. And we live under the rules and the bounds of animal instincts. And the ones which don't, the animals which try and move away from animal instincts the most and be as objective as possible, usually make the best decisions and have the best lives.
Doesn't look like it's changed.
With discipline on top.
You're more detail focused, Tom. Maybe it has changed, but I can't notice the difference. We're waiting for Chairman Powell to walk into that room. A 25 basis point interest rate hike going into it. Your equity market is positive by 0.4% on the S&P 500.
We're going to get rid of old Johnny in a minute.
Yields
I'm
are
going to
just
see
a
on the
little bit
flippers,
lower
Johnny, and then we're
by
going to
3
get Powell.
basis points on a 2-year.
Jerome's going to take it up.
393. Yes, TK.
He's late. I mean, what's it mean? What's it signal?
What's his signal? What's his signal? He's going through the senior loan officer opinion survey.
Just to make sure everything's okay. This is actually unusual. Usually he's pretty prompt. Have you noticed that? This is actually.
He could be on the phone with Goldsby.
I'm not going to read too much into Chairman Powell being seconds late. He's walking into the room right now. The Chairman of the Federal Reserve, after hiking interest rates by 25 basis points.
Supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability.
Can't make it any louder.
Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a
It is quite
percentage
quiet, isn't
point.
it?
Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy
So quiet.
that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
Yeah, maybe that was the move up I was talking about. Could have been better to get a little bit higher.
Significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak.
Did he say no more increase?
Higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Maybe they've got it on the other side.
The labor market remains very tight.
Let's
listen in. Over the first 3 months of the year, job gains averaged 345,000 jobs. Good afternoon.
Is it louder this end?
Before discussing today's meeting,
is it louder, Legends? Can you hear that now?
Recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance.
Getting a little bit of support here, legends. There could be some interesting trades right now.
The participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers.
Oh, pow! Look at your face. Not backed by anything.
Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2%
there could be a scalp here
has a long
on
way
one
to go.
side.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Like I said at the beginning of this video, guys, I thought we were going to get a pop-up and then
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year.
Yeah, this setup isn't ideal.
We are seeing the effects of our policy tightening on demand.
I had a short from up here earlier, but I just took it off.
Sensitive sectors of the economy,
to monitor it,
housing
and then look at this thing.
It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
When we had the actual meeting, it would have been nicer if this had been a little bit slightly postured better.
Is likely to face
and we could have got that move out, and then if we had got that
conditions.
move out, I would have been looking to short up here.
Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses.
This high probability ones here was a nice little scalpy.
In turn, these tighter
it's just not enough in it right now to really see if it was a bit better, maybe, but like
inflation.
No.
The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation.
Yeah, it's not live right now. Should probably get it live.
The staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint,
who got into the long? I said earlier,
I would just
guys.
say this. It's
I won't talk too much, but who got into the long just there?
In a timely way, so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman. Oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But, ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria. Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks. And I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things.
Can you hear me, ladies?
I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately,
banks have gone.
We have to follow the law in our agencies and the law as it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other.
Is the quality good?
Firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. the extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement.
That's SBX right there, Legends.
That's the way we're going to be thinking about it.
Not really moving that
and that's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and make that
might be the pump.
It's an ongoing assessment.
I do think 25K.
And a follow up on credit, if I could. Could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool.
It's got a long way to go, but it's trying, and I do think we will ultimately get support here.
It's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intervening cycle?
Yeah, I mean, as I mentioned,
the need for
I would just say that this assessment
principles.
will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that. That a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel.
Yeah, I think Bitcoin's going to ultimately go to 25K.
We may not be far off, or possibly even at that level.
I think SBX can come down a bit again.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
It's. Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number for every unemployed person.
Nah, not today.
We do see
25K, not today.
some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from
I think there was a scalp long here, to be
late
honest,
last week, and it's whenever it was.
Taking the trade.
And, it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments. But the labor market is very, very strong. Whereas inflation is running high, well above our goal. And right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
I can see something. Matt. I could dick around with some small sizes.
Hi, Chair Powell. Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates.
You're lying again. Can you hear me, legends?
I'm wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast.
Yeah, I think probably 25
the broader
before
committee's
34.
forecast as well,
and guys, can you hear me?
Also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections.
25 before 34, legends.
Deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter.
It's going to be louder
GDP
right there,
at
legends.
that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. You know, it wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern.
Go against
but I do think that the situation in the labor market with so much excess demand, yet wages are actually wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think. The case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that wages are really the principal driver, because I don't think that's really right.
We got this guy who doesn't even understand
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So to get, I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see.
I got some really nice shorts the other day.
Inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael. Whose predictions were
Michael McKee from Bloomberg Radio and
come at me on Twitter, Legends, as well.
Can you tell us something about what your policy
the bit rate is so bad. I'm doing 600 bit rate right now.
Going forward,
that must be hilarious.
When you look at the economy at the next meeting, are you looking at incoming
MEXC and Bybit?
By
get a Bybit account. The link's
are you going to be
it should say Bybit 30,000. If you sign up to Bybit, you can trade.
Are you ruling out
the rate cuts that the market has priced in?
There's actually a trade Bitcoin thing in the chat as well. So this exchange you can see here.
Priced in rate cuts by the end of the year. Do you rule
this exchange here you can trade Pepe on.
So what are we looking
at?
at?
Nice little pop now, guys.
We look at a combination of data and
so let's slamming a YOLO long.
The whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, you know, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth.
This is obviously just a tiny
on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Our small and medium-sized
so this exchange here you can see where I just bought. You can use this exchange to trade Pepe. You can short Pepe, you can long Pepe.
You know, so
the link's in the description, guys. It says Bybit, great exchange. Also, if you use that link, you can get a free month MDX algo. So if you make an account with my link, you can get a free month with MDX
algo.
Just
point out we've raised
and also you can get big bonuses, etc., like deposit bonuses with
and now we
MDX algo. You can actually
credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of,
Moonboy YOLO
our
stuff.
Policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly.
Every time.
But it'll take some time. And in that
inflation's going to come down. Every time we think about it's going to come down, it's going to come down.
To cut rates, and we won't cut rates. If you have a different forecast, then markets have been from time to time pricing in quite rapid reductions in inflation. We'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing services. It really hasn't moved much, and it's quite stable. And, so we think we'll have to, demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Pardon me?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing.
I'm watching this because you guys want to watch it, but
it moved down and then moved back up to where it was.
Dude,
what happened in the
waffling on and on and on.
When there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't
No,
even
not
be
daddy,
talking
pal.
about a world in which the U.S. doesn't
Mummy,
pay its
pal.
bills. It just.
He's a little mama.
It just shouldn't be a thing. And
Little beta
again,
mama.
I would just say we don't. No one should assume that the Fed can do. Can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Ukraine latest. Zelensky denies Russian claim of criminal attack.
Identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I
It's all waffle,
I have read it, of
waffle.
course, and I find it persuasive.
I think it's almost near the end anyway now.
I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do.
I just got it on for everyone who wants to watch this back and actually watch the Fed. People do listen to this.
It may just
site.
have been technology evolving. You know, we have to keep up with all that. But some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about is. And I feel like I am accountable for doing everything I can to make sure that happens.
Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. Large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
This stream's been 6 hours almost.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it.
It's all easy saying that after you fuck everything up.
I agree with and will support
How's
those
about let's not have you in this, this place in the
personally
have you in this
accountable
situation
to
in the first
what
place?
I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory
Yeah,
rule,
you can
which is
short
quite
PEP
unusual.
on Bybit,
Vice
so get
Chair,
an account. There's a link in the description.
It says,
if you
shall
use that
deploy
link below as
policy
well, you can also get a
recommendations,
free month of MDX
develop
Algo. So
policy recommendations for the board regarding
go over to
supervision and
MDX Algo
regulation
and get
of
that
depository
as
institution
well. You can
companies,
claim a free month.
and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as vice chair for supervision, who really gets to set the
I've been
agenda
calling for 25 for a
supervision and
long time,
regulation for the
guys,
Board of
before
Governors.
anyone was even
Congress
thinking
wanted
about
that
it.
person
I
to
shorted the
be
retest
to have
stuff, but
political accountability for
the last
developing that
pump,
agenda. So
that was a
way
really
it
nice
works, the
short.
way it
It's
has
come
worked
back
in
up
practice
now.
for me
Now I'm
is
kind of looking
I've had a
to
good
just hold on to
working
my cash and
relationship.
wait for
I give
25
my
for then
my counsel,
significant
my
trades.
input.
Obviously, anything
privately.
on lower time
And-
frames like this,
and
these
I
tiny
offer that.
scalps aren't
And,
really.
I have good conversations,
worth
and,
really
and I
putting the
try to
time into if you
contribute
want to get
constructively. I
those-
respect
those
the
decent
authority that
gains on the
Congress has
swings. You
deferred
can do high
on that
velocity for
person.
sure. But I would say,
with
the
Vice
end
Chair
of the
Barr
day,
and
you
his
want to be looking
predecessor.
for those big pivot
And,
point swings.
I
and
think
that's where
that's
you
the
can
way
really
it's supposed
scoop
to
up
work,
some
and that's
cheddar chunk
appropriate.
cheese.
I believe that's what the
But
law
I'm probably gonna bounce,
requires.
Legends.
And, you know, but
He's pissing me off.
I wouldn't say it's a matter of complete deference. It's more,
SPX
I have
is
a
breaking down,
role
so it's probably
in
gonna have a-
presenting my views and discussing, having an intelligent discussion about what's going on.
We lose this
and
level
why.
here, guys, on
And,
SPX.
you know,
We're going to go
that's
25 count
my
Bitcoin,
input,
okay?
but
We're likely to
ultimately
come down
that
low on
person does
SPX.
get to set the agenda and gets to take
And,
things to the Board of Governors.
It means
And really
that,
in supervision
we're going to go
has
25 like I
sole
said from
authority
the
over
beginning.
supervision.
You know, just I got a shitload of cash
Just
I've been
wondered if you
accumulating
had any
for
regrets,
the last
or
like
was there
few weeks
anything
or
that,
maybe
you
even a
know,
month now.
decisions
So I'm just
that
going to buy
maybe you
25 of
regret
that
now
cash.
in light of what's happened?
I've had a few. Sure. I mean, you know, who
Short
doesn't
the
look
Ponzi
back and
legends.
think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control
No,
now
don't
is make a
control
fair
anything, you
assessment,
fucker.
learn the right lessons.
'Cause you controlling it might be
figure
the
out
wrong
what
thing.
The fixes are and implement them.
God, they're such
And
power
I think
greedy
that
fuckers.
Vice Chair
Control what I
Barr's
can,
report is an
control
excellent
everything.
first
No,
step
we
in
don't
that,
want you
but
to
we've
control,
gotta
you
follow through.
fucking socialist fuck. We need you to not control it because you're wrong. God, these people.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board.
Yeah, I've got the news up because it's just something, an
I would say
event
there are
which
a
a lot
number
of people
and
use
you'll see
as
this in the minutes. I don't want to try to do the head
a
count,
focal point of the day, so you have it running
in
and
real
then
time, but
you know, it's
people
just
did
interesting
talk
to
about
see his
pausing, but
bollocks,
not so
but
much at this meeting. You know,
it's
that
not what
we're-
I'm into
I mean,
really,
there's a
but
sense
I do
that we're
ultimately just
you know,
have a
we're
listen
much
and then-
closer to the end of this than to the beginning.
Makes
that,
me
you know,
really,
as I
it
mentioned,
just
if you add
solidifies
all
or
the
makes
tightening
me
that's
more
going on through
confident in the
various
fact
channels,
that we need to have more
it's-
free market principles in
we feel
society
like
and not
we,
rely on people
we're
like
getting
this
close
to control
or maybe even
the
there.
interest rate of
But
all
that, again,
money
that's going to
in
be an ongoing
society.
assessment, and we're going to be looking at those factors that we listed and to determine whether there's more to do.
I'm curious too how to interpret
has an
that
impact,
and,
but
and
it
the
has
changes
no
to the statement.
quantifiable
Is the bar higher now to
impact
raise
which you can
rates at the
trade
next meeting, or
on.
would a
Okay, so
strong
there's no-
jobs report or inflation
It's completely
print be enough
subjective, all of this
to push the Fed to
information.
tighten
You
again?
can take it positively, you can take it negatively.
I don't wanna-
There's no
I
survey
couldn't-
which
I
says,
couldn't
did
really
you buy,
say.
did
I
you
just
sell?
think we're-
So there's no
I think
objectivity
look,
in
I
this,
think
so you
we've
might as
moved a
well
long
not have
way
it in your
fairly
analysis
quickly,
because there's
and
no
I
way to
think
make
we
money
can afford to look at the
using this
data
as data
and,
to make an
and make a
informed
careful
decision because it's
assessment.
subjective, not objective.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing.
Yeah, I think ultimately we go 25, guys.
I guess I would just say that.
Before we go to 35.
You know, we're going to, obviously, we're going to
35,
revisit. It's pretty
first.
clear we need, to me anyway, it's clear that we need to strengthen both supervision and regulations for banks of this size. And I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
That does it for the main news conference of the Federal Reserve, with Chairman Jay Powell there following a 25 basis point increase. Looking ahead on the economy,
Thank you,
this is what he had
Jonathan.
to say. His forecast is for modest growth, not a recession.
Right, legends. I'll see you on the flippers. You're all legends. Get a Bybit account. Get an OKX account. You don't need a KYC with OKX. The links are below, guys. Get the exchanges. You know what to do. Also, if you get a Bybit account with my link, you can get a free month of MDX Algo at the moment. So you might as well get one with my link, and then you can get a free ship. Also, you can get some sign-up bonuses for cash to trade. Actually, when you get the free month with MDX Algo, you can also get $1,000 free position. So no deposit, just a free position to trade with. So get a new account, get a new Bybit account, and then if you go through the steps, you can actually get a free MDX Algo account for the first month and a free $1,000 position. So check it out, guys. The link is Bybit 30,000. I'll see you on the flippers, legends. You are all home dogs of this channel. I'm looking for 25k over the next few months, or maybe less. And ultimately, I've got cash, so in essence, I'm short. All right, legends, have a good one. I'll see you on the flippies.